The Intelligent Investor, Revised Edition, the definitive book on value investing. Written by Benjamin Graham and read by Edward B. Benjamin Graham, revered as one of the preeminent figures in investment history, stands as a beacon of rationality and wisdom in the often turbulent realm of finance. His seminal works, particularly Security Analysis and The Intelligent Investor, not only revolutionized the practice of investing, but also bestowed upon individual investors a profound understanding of the emotional and analytical underpinnings essential for financial success. Prior to Graham's contributions, the investment landscape was mired in superstition and guesswork, akin to a medieval guild, lacking the structured approach that Graham would later champion. His groundbreaking insights crystallized in Security Analysis, effectively transforming investing from an art into a science, grounded in meticulous research and disciplined analysis. The Intelligent Investor, a timeless masterpiece, represents the first comprehensive guide tailored specifically for individual investors. Within its pages, Graham delineates the emotional fortitude and analytical acumen requisite for navigating the capricious currents of the market. His prescience regarding the inevitable conclusion of bull markets, underscored by the historic crash of 1987, underscores the enduring relevance of his principles. Graham's journey to mastery was paved with adversity, from the financial struggles of his youth to the harrowing losses endured during the Great Crash of 1929 to 1932. Yet it was through these trials that he honed his principles, anchoring them in a bedrock of experience, intellect, and common sense. Central to Graham's philosophy is the notion that stocks represent tangible ownership in real businesses, their intrinsic value transcending mere fluctuations in share price. He astutely recognized the pendulum-like nature of the market, oscillating between exuberant optimism and unwarranted pessimism, offering astute investors opportunities to buy low and sell high. The concept of a margin of safety, epitomizing Graham's prudent approach, underscores the imperative of avoiding overpayment and minimizing the risk of error. By cultivating a disciplined mindset and eschewing the herd mentality pervasive on Wall Street, investors can seize control of their financial destiny, insulated from the vicissitudes of market sentiment. In this revised edition of The Intelligent Investor, Graham's timeless principles are juxtaposed against the backdrop of contemporary financial markets, demonstrating their enduring applicability. Through insightful commentaries and relevant examples, readers are afforded a nuanced understanding of how Graham's teachings can be effectively employed in today's investment landscape. Engaging with Graham's masterpiece, whether for the first time or as a seasoned investor, promises not only enlightenment, but also empowerment. Like all enduring classics, its insights transcend time, offering perpetual guidance to those who seek to navigate the complexities of investing with intelligence and prudence. With Graham as their guide, investors are equipped to embark on a journey towards heightened financial acumen and ultimately success. In the preface to the fourth edition of his timeless masterpiece, Warren E. Buffett reflects on his enduring admiration for Benjamin Graham's seminal work, which he first encountered as a young investor in 1950. Buffett's reverence for Graham's teachings remains steadfast, as he asserts that the intelligent investor retains its status as the paramount guide to successful investing. Central to Buffett's endorsement is Graham's assertion that investment success is not contingent upon extraordinary intelligence or privileged information, but rather on the cultivation of a robust intellectual framework and the mastery of emotional discipline. Emphasizing the book's role in furnishing such a framework, Buffett underscores the pivotal significance of chapters 8 and 20, which offer invaluable guidance for navigating the complexities of the market. Drawing upon his own experiences, Buffett avows that adherence to Graham's behavioral and business precepts ensures a favorable investment outcome, insulating practitioners from the caprices of market irrationality. He contends that while the attainment of exceptional results hinges upon individual effort and acumen, adherence to Graham's principles positions investors to capitalize on market anomalies and avoid succumbing to speculative fervor. Buffett's personal connection to Graham transcends that of a mere mentor. He characterizes Graham as a profound influence on his life, second only to his father. In a poignant tribute penned following Graham's passing in 1976, Buffett articulates the profound impact of Graham's mentorship, a sentiment he believes readers will discern as they delve into the pages of The Intelligent Investor. In essence, Buffett's preface serves not only as an endorsement of Graham's enduring wisdom, but also as a testament to the enduring legacy of a mentor whose insights continue to shape the investment philosophy of generations. Introduction. This book endeavors to serve as a comprehensive guide for individuals seeking to navigate the realm of investment, presented in a manner accessible to those without specialized financial expertise. Rather than focusing extensively on the technical analysis of securities, our emphasis lies in imparting fundamental investment principles and cultivating a prudent investor mindset. While occasional comparisons between specific securities will be provided, our primary objective is to elucidate historical market patterns spanning several decades. We believe that an informed understanding of how various types of bonds and stocks have historically performed under diverse economic conditions is indispensable for making sound investment decisions. As famously noted by Santayana, those who do not remember the past are condemned to repeat it, a cautionary adage particularly relevant in the context of Wall Street. Addressing investors rather than speculators, we aim to clarify and underscore the distinction between the two, a distinction that has somewhat faded over time. This is not a manual promising instant wealth or prescribing speculative trading strategies. Rather, we draw from historical examples to underscore the perils of relying on overly optimistic forecasts or succumbing to market speculation. Our observations, gleaned from over 5 decades of market experience, challenge the efficacy of popular technical approaches and advocate for a more principled, long-term investment strategy. Since its inception in 1949, this book has undergone periodic revisions to reflect evolving market dynamics. The current edition sees significant developments since the 1965 edition, including unprecedented fluctuations in bond interest rates, substantial market declines, persistent inflationary pressures, and emerging trends in corporate finance. These shifts necessitate a nuanced reassessment of investment strategies while upholding timeless principles. Notably, our discussion encompasses the challenges and opportunities presented by fluctuating interest rates, market volatility, and evolving investment vehicles. We advocate for a balanced approach tailored to prevailing market conditions, emphasizing prudent risk management and informed decision-making. Our insights seek to empower readers to navigate the complexities of the investment landscape with confidence and resilience. Furthermore, we delineate between defensive and enterprising investors, offering tailored guidance to each cohort based on their risk tolerance and investment objectives. While the allure of identifying high-growth industries and companies is undeniable, we caution against over-reliance on speculative ventures and emphasize the importance of disciplined, value-oriented investing. Central to our philosophy is the principle of margin of safety, wherein investors prioritize the preservation of capital over speculative gains. We advocate for a rational, measured approach to stock selection, grounded in a thorough assessment of tangible asset value and long-term growth prospects. While the allure of speculative ventures may be enticing, we underscore the merits of a conservative investment policy rooted in sound fundamentals. Ultimately, this book seeks to equip readers with the knowledge and mindset necessary to navigate the uncertainties of the investment landscape effectively. By fostering a disciplined, informed approach to investment decision-making, we aim to empower readers to achieve their financial goals while mitigating unnecessary risks. Commentary on the introduction. Henry David Thoreau's quote, "If you have built castles in the air, your work need not be lost. That is where they should be. Now, put the foundations under them," sets the tone for the introduction by emphasizing the necessity of grounding ambitious goals in solid foundations. This mirrors the philosophy of the book, which, from the outset, differentiates itself by not promising market-beating strategies, but by teaching essential principles for long-term investment success. The introduction outlines three core lessons: minimizing irreversible losses, maximizing sustainable gains, and controlling self-defeating behavior. These are crucial for navigating the often turbulent waters of investing, especially evident in the aftermath of the late 1990s tech boom and subsequent bust. By 2002, many once high-flying tech stocks had plummeted, underscoring the risks of speculative investments and the importance of Graham's emphasis on loss avoidance. Despite the inevitability of market downturns, the book promises strategies to manage these risks and maintain composure. This brings us to the concept of the intelligent investor, which Graham defines not by academic or intellectual prowess, but by qualities such as patience, discipline, emotional control, and independent thinking. Historical examples, like the collapse of long-term capital management and Sir Isaac Newton's speculative failures, illustrate that even the most intellectually gifted individuals can fall prey to market irrationality when they lack these traits. The narrative then shifts to a broader critique of recent financial disasters, from the dot-com crash to corporate scandals involving Enron and WorldCom. These events highlight the perils of unchecked enthusiasm and the critical importance of Graham's principles. Investors who ignored his warnings and allowed market euphoria to cloud their judgment experienced severe losses, affirming Graham's assertion that an investor's worst enemy is often themselves. In contrasting past irrational exuberance with current pessimism, the introduction argues that the recent market downturn presents a more favorable environment for prudent investing. The intelligent investor understands that rising stock prices increase risk, while falling prices decrease it. This counterintuitive approach encourages a long-term perspective, welcoming bear markets as opportunities to acquire assets at lower prices. In summary, the introduction sets the stage for a deeper exploration of investment principles that prioritize stability and rationality over short-term gains and market speculation. It promises to equip readers with the tools to build resilient investment foundations, aligning their ambitions with the disciplined, thoughtful approach advocated by Graham. Chapter 1: Investment versus Speculation. Results to be expected by the intelligent investor. Investment versus speculation. The chapter sets out to clarify the fundamental difference between investment and speculation, a distinction that is crucial for the individual, non-professional investor. This differentiation was first articulated in 1934 in Security Analysis, with the definition: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Despite the evolution in the financial landscape since then, this definition remains pertinent. Post the 1929-1932 market crash, common stocks were largely deemed speculative, necessitating a defense of the investment definition to encompass stocks. However, contemporary misuse of the term investor to include all market participants, regardless of their methods or objectives, has led to significant confusion. The chapter underscores the misuse of the term through historical examples, illustrating how mislabeling speculative activities as investment can be misleading and potentially harmful. To prevent this confusion, it is emphasized that speculation involves taking on higher risk for higher potential returns, often with insufficient analysis and consideration of safety of principal. In contrast, investment is characterized by a meticulous approach focused on preserving capital and earning reasonable returns. Results to be expected by the defensive investor. The chapter also introduces the defensive investor, who prioritizes safety and minimal effort in managing their portfolio. The defensive investor should maintain a balance between high-grade bonds and leading common stocks, typically maintaining a 50-50 ratio, but allowing for adjustments based on market conditions. Historically, the defensive investor could expect a return from stocks consisting of dividends and appreciation, averaging about 7.5% annually. This return, while lower than historical stock market gains, is considered more reliable and sustainable. Policy recommendations in various market conditions. Examining the period from 1964 to 1971, the text notes significant changes in bond yields and stock market returns, leading to the conclusion that bonds might sometimes be a preferable investment. However, due to the unpredictability of markets, it advocates for a balanced approach with a substantial portion of funds in both bonds and stocks to mitigate risk. Additional considerations. The chapter concludes by suggesting supplementary strategies for the defensive investor. 1. Investment funds. Investing in well-established investment funds or utilizing the services of investment counsel firms for professional management. 2. Dollar cost averaging. Consistently investing a fixed amount in stocks at regular intervals, ensuring more shares are purchased when prices are low and fewer when prices are high, averaging out the cost. 3. Formula investing. Adjusting stock holdings in response to market movements, maintaining a dynamic yet balanced portfolio. These strategies, alongside a fundamental understanding of the distinction between investment and speculation, are aimed at guiding the defensive investor toward achieving stable and satisfactory returns. Expected outcomes for the aggressive investor. An aggressive or enterprising investor, by definition, seeks to outperform the market by achieving higher returns compared to a more passive or defensive approach. However, the primary objective for such an investor should be to avoid underperforming. While energy, thorough research, and innate skill can be valuable assets, they can also lead to losses if misdirected. Therefore, a clear understanding of which strategies have a realistic potential for success is crucial. Common strategies and their pitfalls. 1. Trading in the market. This strategy involves buying stocks during market upswings and selling them during downturns. Typically, these stocks are those outperforming the market. Some investors engage in short selling, betting on the decline of certain stocks to profit from buying them back at lower prices. However, trading is inherently speculative and does not offer the security of principal or satisfactory returns when subjected to thorough analysis. 2. Short-term selectivity. This involves purchasing stocks of companies that are expected to report favorable earnings or other positive developments. The challenge here is that these anticipated outcomes are often already reflected in the stock prices, diminishing the potential for above-average returns. 3. Long-term selectivity. This strategy focuses on companies with a strong track record of growth, anticipated to continue into the future. It also includes investing in emerging companies in promising sectors like technology or pharmaceuticals. However, predicting long-term success is fraught with uncertainty, and even accurate predictions might already be priced into the stock. The challenges of stock selection. Selecting stocks based on near-term or long-term prospects presents significant obstacles. Investors can be wrong in their forecasts, and even correct predictions may not yield higher returns if the market has already accounted for them. The intense competition and expertise in Wall Street make it difficult for individual investors to consistently outperform professional analysts. Sound and unconventional policies. For better-than-average results, investors must adopt strategies that are both inherently sound and not widely practiced on Wall Street. While speculative movements often lead to mispricing, identifying and capitalizing on undervalued stocks due to lack of interest or unjustified bias requires patience and resilience. Similarly, short-selling overvalued stocks demands not only financial acumen, but also considerable courage and financial stability. Special situations. Historically, special situations such as intersecurity arbitrages, liquidations, and certain hedges offered opportunities for substantial returns with minimal risk. Merger and acquisition deals, in particular, provided profitable avenues, though increasing competition and obstacles have diminished these opportunities. Historical perspectives and changing dynamics. In the past, various strategies, such as buying stocks below their intrinsic value or employing the Dow theory, proved successful. However, changes in market dynamics and increased competition have reduced the reliability of these methods. For instance, sub-working capital stocks, once common and profitable, have become scarce. Current opportunities. Despite these challenges, opportunities still exist for the enterprising investor. The vast array of marketable securities inevitably includes undervalued stocks that can be identified using logical and reliable standards. Achieving satisfactory returns from these investments would require adding approximately 5% annually before taxes to the average market return. The goal is to develop effective stock selection approaches that justify the investor's effort and resources. In conclusion, while aggressive investing comes with inherent risks and challenges, a disciplined approach grounded in sound, less conventional strategies can offer the potential for superior returns. Commentary on Chapter 1: Investment versus Speculation. In the opening chapter of The Intelligent Investor, the distinction between investing and speculation is made abundantly clear. Benjamin Graham, the father of value investing, emphasizes that true investment is rooted in thorough analysis, safety of principle, and adequate returns. He contrasts this with speculation, which he describes as betting on price movements without regard to the underlying value. Investing defined by Graham. Graham's definition of investing is stringent and methodical. 1. Thorough analysis. Investors must deeply understand a company and its business before purchasing its stock. 2. Safety of principle. Protecting against significant losses is paramount. 3. Adequate returns. Investors should aim for satisfactory, not extraordinary performance. Investors, according to Graham, determine the worth of a stock based on the value of the business it represents, while speculators are merely concerned with market price fluctuations. The dangers of speculation. The allure of speculation is likened to gambling, with the stock market often compared to a casino. The excitement and potential for quick gains draw many into speculative trading, yet Graham warns that this is a perilous path. Speculators contribute to their brokers' wealth rather than their own, driven by a misinterpretation of market movements and short-term gains. Historical context and examples. Graham's insights are supported by historical examples. The commentary highlights the rampant speculation of the 1990s, where investors abandoned patience and prudent analysis for rapid trading and speculative strategies. Notable instances include Fidelity Magellan Fund, managed by Jeffrey Vinnick. This fund saw rapid turnover in technology stocks, despite the manager's purported long-term approach. Online trading boom. The late 1990s saw a surge in online trading, often driven by misleading advertisements suggesting quick and easy profits. Speculative bubbles. Stocks like Puma Technology and companies with fleeting internet buzz experienced wild price swings detached from their actual business value. Flawed strategies. Several speculative strategies that gained popularity are critiqued for their lack of sustainability. The January effect. Initially profitable, this strategy's returns diminished as more investors exploited the opportunity. What works on Wall Street, James O'Shaughnessy's method, once publicized, quickly underperformed. The Foolish Four. Promoted by the Motley Fool, this simplistic strategy ultimately failed to deliver on its promises. Lessons from Graham. Graham's teachings underscore the need for a disciplined approach to investing. He advises against confusing speculation with investment and suggests maintaining a small, separate account for speculative endeavors, limiting it to 10% of one's total portfolio. This approach acknowledges the human tendency towards gambling, but confines it within safe bounds. Conclusion. Chapter 1 serves as a foundational lesson in distinguishing between investing and speculation. By adhering to Graham's principles of thorough analysis, risk management, and reasonable expectations, investors can avoid the pitfalls of speculation and build sustainable wealth. The chapter's timeless advice remains relevant, reminding investors to stay grounded in fundamentals and wary of the seductive but dangerous allure of speculation. Chapter 2: The Investor and Inflation. In recent years, inflation and the measures to combat it have become a significant concern for the public and have heavily influenced Wall Street's mindset. The erosion of the dollar's purchasing power and the fear or speculative hope of a further decline has highlighted the plight of those with fixed dollar incomes or fixed dollar principles, as their value diminishes with rising living costs. Conversely, stockholders might find some compensation through potential increases in dividends and share prices. This situation has led many financial experts to assert that bonds are inherently less desirable investments compared to stocks. Some have gone so far as to advise charitable institutions to shift entirely from bonds to stocks, a stark contrast to past legal restrictions on trust investments that favored high-grade bonds. It is crucial to recognize that no investment is universally superior under all conditions. Even high-quality stocks cannot always outperform bonds, especially when stock markets are overheated and dividend returns are low compared to bond yields. Such a sweeping statement would be as misleading as the old belief that any bond is safer than any stock. This chapter will employ various metrics to assess the impact of inflation, helping investors make informed decisions about future price level expectations. Historical perspective on inflation. To form a sound future policy, one must understand past experiences with inflation. Is the current inflation trend unprecedented in the US? By examining historical data, including Table 2.1, which spans from 1915 to 1970, we see that inflation is not new. The period from 1915 to 1920 saw a significant cost of living increase, nearly doubling, compared to a 15% rise between 1965 and 1970. This historical context suggests a likelihood of continued or recurrent inflation. Predicting future inflation rates. Determining future inflation rates is challenging, as historical data shows significant variation. However, a reasonable approach would be to consider the average inflation rate of the past 20 years, which was 2.5%, with a higher rate of 4.5% from 1965 to 1970. Federal policies aimed at curbing inflation may be more effective in the future, suggesting a probable, though not certain, future inflation rate of around 3% annually. This projected rate implies that about half the income from good medium-term tax-free bonds could be eroded by inflation, though it doesn't necessarily reduce the purchasing power of an investor's capital if managed prudently. Stocks versus bonds in an inflationary context. Many argue that stocks, with their potential for higher returns, offer better inflation protection than bonds. Historical data shows that from 1915 to 1970, the DJIA's compounded annual return was about 8%, combining stock price growth and dividend returns. This outperformed bonds over the same period. However, this doesn't guarantee that stocks will outperform bonds in the future, especially in the short term, where market volatility can significantly impact investor sentiment and decisions. Inflation and corporate earnings. A critical analysis of corporate earnings relative to inflation reveals no consistent correlation between rising inflation and increased earnings. Despite significant inflation between 1950 and 1970, corporate earnings rates have not kept pace, partly due to higher depreciation rates and increased corporate debt. The increased use of debt, combined with rising interest rates, has become a substantial economic challenge, limiting the benefits of inflation on corporate profitability. Real estate and alternative investments. While tangible assets like gold and real estate are traditionally seen as inflation hedges, their effectiveness varies. Gold has shown limited success in preserving purchasing power over long periods, and real estate investments come with risks such as location, pricing, and market fluctuations. Diversification remains a critical strategy for managing these risks. Conclusion. Given the uncertainties surrounding inflation and market conditions, investors should avoid concentrating their portfolios entirely in stocks or bonds. A balanced approach, incorporating both asset classes, can provide better protection against unforeseen market changes. Conservative investors, in particular, should prioritize risk minimization, acknowledging that while bonds offer stability, a stock component is necessary to hedge against potential inflation. Despite current market conditions, maintaining a diversified portfolio remains a prudent strategy for managing future financial risks. Commentary on Chapter 2, Understanding Inflation and Investment Strategies. Henny Youngman's humorous observation about grocery prices encapsulates a serious economic concept, inflation. While it may seem negligible, the long-term effects of inflation can significantly impact an investor's purchasing power and financial well-being. Chapter 2 delves into the intricacies of inflation and how it affects investment decisions, providing essential insights for the intelligent investor. The money illusion and inflation's deceptive nature. Inflation's subtlety makes it easy to ignore, but it remains a crucial factor in financial planning. The concept of the money illusion, where nominal changes in salary or investment returns are perceived positively regardless of their real value after inflation, illustrates how individuals can be misled about their financial health. For instance, a 2% raise during 4% inflation feels better than a 2% pay cut with zero inflation, even though both scenarios result in a 2% loss in purchasing power. This illusion can lead investors to misjudge their true financial status, emphasizing the need to consider real returns over nominal gains. Historical context and potential risks. The chapter warns against complacency by highlighting past periods of high inflation, such as the 1973 to 1982 era, when inflation rates soared, drastically reducing the value of money. This historical perspective serves as a reminder that inflation, though currently low, can resurge, eroding wealth and destabilizing economies. The global context further underscores the risk, as many market-oriented countries have experienced severe inflation, demonstrating that the United States is not immune to such economic disruptions. Investment strategies to mitigate inflation risks. To guard against inflation, the chapter suggests diversifying investments beyond traditional stocks. While stocks have historically outpaced inflation over long periods, they are not foolproof. The chapter introduces two effective inflation hedges: real estate investment trusts, REITs, and Treasury inflation-protected securities, TIPS. 1. REITs. These investments offer a practical way to combat inflation by owning and renting commercial and residential properties. REITs, especially when bundled into mutual funds, can provide a steady income stream and potential appreciation in value, offsetting inflation's impact. 2. TIPS. These government bonds are designed to increase in value with inflation, ensuring that the investment's purchasing power is preserved. TIPS are particularly suitable for tax-deferred retirement accounts, where they can grow without immediate tax implications, providing a safe and stable inflation hedge. Conclusion. Chapter 2 emphasizes the importance of accounting for inflation in investment strategies. By understanding the money illusion and historical inflation trends, investors can make informed decisions to protect their wealth. Diversifying into REITs and TIPS can offer robust defenses against inflation, ensuring that investment returns maintain their real value over time. For the intelligent investor, staying vigilant about inflation and strategically allocating assets are key to achieving long-term financial security. Chapter 3. A Century of Stock Market History, the Level of Stock Prices in Early 1972. Chapter 3 offers a comprehensive analysis of the stock market's historical fluctuations, focusing on the level of stock prices as of early 1972. The primary aim is to provide investors with an informed perspective on market trends, enabling them to make prudent investment decisions. Overview and historical data. The chapter emphasizes the importance of understanding the historical movements of stock prices, earnings, and dividends over the past century. This historical context, dating back to 1871, allows investors to gauge the relative attractiveness or risks associated with current market levels. The data, although more reliable in the latter half of the century, includes major fluctuations that highlight the stock market's underlying growth through numerous cycles. Key historical patterns and data presentation. The chapter presents this historical data through two tables and a chart. Table 3.1 details the low and high points of 19 bear and bull markets over the last 100 years, utilizing two main indexes: the Standard & Poor's Composite Index 500 stocks and the Dow Jones Industrial Average, DJIA. Chart I, courtesy of Standard & Poor's, visualizes the fluctuations of its 425 industrial stock index from 1900 through 1970, revealing three distinct patterns. 1. 1900-1924, characterized by cycles lasting 3 to 5 years with an average annual advance of about 3%. 2. 1925 to 1949, marked by the New Era bull market ending in 1929, the subsequent crash, and irregular fluctuations with an annual growth rate of just 1.5%. 3. 1950 to 1970, the period of the greatest bull market in history, with significant advances culminating in December 1968. Market cycles and investment sentiment. The analysis highlights the substantial market gains from mid-1949 to early 1966, with the DJIA rising more than sixfold. Despite important setbacks, the rapid recoveries led to a consistent bull market. However, the significant returns documented during this period fostered an unrealistic expectation of perpetual high returns, leading to the severe market correction between 1968 and 1970. Earnings, dividends, and price-earnings ratios. The chapter also compares stock prices with corresponding earnings and dividends, using 10-year averages to illustrate the long-term growth patterns. Notably, the post-World War II era saw superior performance compared to earlier decades, but the growth rate in the 1960s was less pronounced than in the 1950s. A notable point is the deterioration in corporate earnings in 1970, marked by the lowest profit rates since the World War and significant bankruptcies. 1972 market evaluation. As of early 1972, stock prices were analyzed in relation to earnings and bond yields. The price-earnings ratio for the market was lower than in 1963 and 1968, but higher than in the early years of the bull market. The chapter concludes that the adverse change in the bond yield-stock yield ratio offsets the better price-earnings ratio, rendering the market unattractive for conservative investors at the time. Despite technical indications favoring a substantial rise, the disregard of recent market downturns suggests caution for investors. Conclusion and investment recommendations. The chapter revisits past evaluations of market levels from previous editions, reflecting on the difficulty of accurately predicting market movements. It underscores the value of a consistent and controlled investment policy over attempts to time the market or pick individual winners. The prudent course suggested includes avoiding borrowing for securities, maintaining a balanced portfolio with a maximum of 50% in stocks, and potentially suspending new investments if the market level is deemed dangerous. In summary, Chapter 3 provides a detailed historical analysis of the stock market, highlighting the importance of historical context and prudent investment strategies amidst fluctuating market conditions. Commentary on Chapter 3, Bull Market Baloney. In Chapter 3 of The Intelligent Investor, Benjamin Graham demonstrates remarkable foresight, predicting the severe bear market of 1973 to 1974, where U.S. stocks plummeted by 37%. His critique extends well into the future, dismantling the flawed reasoning of market pundits and popular investment literature that emerged long after his time. The perils of extrapolation. Graham's central thesis is a caution against the dangerous habit of predicting future market performance solely based on past trends. This flawed approach gained popularity in the 1990s, with a slew of optimistic projections exemplified by books like Jeremy Siegel's Stocks for the Long Run, and more extreme forecasts such as Dow 36,000 and Dow 100,000. These predictions were based on the historical average returns of stocks, leading some to absurdly conclude that stocks were inherently less risky than bonds or cash, provided they were held long enough. The fallacy of new paradigms. The chapter highlights the irrational exuberance of the late 1990s, epitomized by industry experts who dismissed the overvaluation of tech stocks and proclaimed a new world order. Examples include Kevin Landis's defense of wireless telecommunication stocks and Robert Froelich's advocacy for high-priced companies. However, Graham asserts that the market inevitably punishes such heedless optimism, a fact brutally illustrated by the market crash that followed. Survivorship bias and historical overstatement. Graham addresses the issue of survivorship bias in historical stock market data. Early stock indexes, which show impressive long-term returns, often exclude companies that went bankrupt, thus overstating the actual returns experienced by investors. Elroy Dimson's research further debunks the notion that stocks always outperform bonds, revealing that pre-1871 stock returns are significantly inflated. Market valuation and future returns. Graham's skepticism extends to market valuations, emphasizing that the price paid for an investment critically determines its future returns. He warns against assuming that the high returns of the late 1990s could continue indefinitely. Graham's prudent approach involves realistic expectations. In the long run, stock returns are driven by real growth, inflation, and changes in investor sentiment. At the start of 2003, these factors suggested a modest 6% annual return for stocks. The importance of humility in forecasting. One of the key lessons Graham imparts is the inherent uncertainty of financial forecasting. He advises maintaining humility and caution, recognizing that the market often surprises those who are most confident in their predictions. By staying modest and diversified, investors can protect themselves from the inevitable fluctuations of the market. Optimism amidst uncertainty. Despite advocating for lowered expectations, Graham remains fundamentally optimistic. He echoes G.K. Chesterton's sentiment that those who expect little can find joy in unexpected outcomes. For the intelligent investor, maintaining a hopeful yet realistic outlook is essential, as market lows often precede periods of significant recovery. In summary, Chapter 3 of The Intelligent Investor serves as a timeless reminder of the dangers of overconfidence and the importance of realistic, humble investment strategies. Graham's insights encourage investors to critically evaluate market valuations, avoid the pitfalls of historical extrapolation, and maintain a balanced perspective on future returns. Chapter 4: General Portfolio Policy for the Defensive Investor. Characteristics of investment portfolios. The construction of an investment portfolio should align with the characteristics and risk tolerance of the owner. Institutions like savings banks, life insurance companies, and legal trust funds historically limited their investments to high-grade bonds and preferred stocks due to legal constraints. In contrast, seasoned and affluent investors might include a broad array of stocks and bonds, driven by perceived attractiveness rather than strict adherence to high-grade securities. A long-standing investment principle suggests that those unable to bear high risks should accept lower returns. Conventionally, the rate of return sought is thought to correspond to the level of risk an investor is prepared to undertake. However, this perspective is challenged here. Instead, the return should correlate with the intelligent effort an investor is willing to commit. Passive investors, seeking safety and minimal engagement, should expect lower returns. Conversely, active, knowledgeable investors might achieve higher returns, potentially encountering less risk with well-selected bargain issues than with standard high-grade bonds. Bond stock allocation. For a defensive investor, a balanced portfolio of high-grade bonds and common stocks is recommended. A foundational rule is that the portfolio should maintain a minimum of 25% and a maximum of 75% in common stocks, with an inverse proportion in bonds. Typically, an equal division, 50-50, between these two categories is advisable. Increasing the stock percentage is suggested when stocks are undervalued during bear markets, and decreasing it when markets are overvalued. However, maintaining such disciplined adjustments is difficult due to inherent human tendencies that fuel market extremes. Consequently, a simplistic but effective 50-50 allocation formula is proposed. This approach advocates for maintaining equal division, adjusting proportionally as market values fluctuate. For example, if the stock portion grows to 55%, rebalancing would involve selling some stocks and buying bonds, and vice versa if the stock portion drops to 45%. Historical application of similar strategies, like Yale University's earlier approach, shows challenges during significant market advances, which often lead institutions to abandon such formulas. Nonetheless, the 50-50 strategy is practical and provides a safeguard against excessive market exposure. The bond component. When selecting bonds, investors should consider two main questions: choosing between taxable and tax-free bonds, and deciding on maturity lengths. Tax considerations are straightforward, depending on yield differences and the investor's tax bracket. In the early 1970s, for instance, high tax brackets favored tax-free bonds due to better net returns. Deciding between long and short maturities depends on the investor's desire for price stability versus yield potential. Long-term bonds might offer higher yields but carry greater risk of price decline. Shorter maturities offer stability but with lower yields. U.S. savings bonds remain attractive due to their safety, tax advantages, and flexibility. Despite their lower yield, their unique features, like assured redemption value and tax deferral, make them suitable for investors, especially those with modest capital. Other high-grade bonds. Various high-grade bonds, including USA government bonds and top-rated corporate bonds, provide safe investment options with different yield profiles. Investors in high tax brackets can benefit more from tax-free municipal bonds, while those in lower brackets might prefer taxable bonds for their higher yields. The choice of bonds should balance safety, yield, and the investor's tax situation. Higher yielding bonds and savings deposits. While higher yielding, lower grade bonds offer potential for better returns, they also carry significant risks, making them unsuitable for defensive investors. Instead, high-yield savings deposits in banks can be a prudent alternative, offering competitive rates without the associated bond risks. Convertible issues and preferred stocks. Convertible bonds and preferred stocks are generally more complex and less favorable for defensive investors due to their variability and potential instability. Preferred stocks, while sometimes offering higher returns, depend heavily on the issuing company's performance and dividend policies, making them less reliable compared to bonds. Conclusion. For the defensive investor, maintaining a balanced, diversified portfolio with a disciplined approach to bond and stock allocation is crucial. High-grade bonds and stocks, combined with periodic rebalancing, provide a robust strategy to achieve reasonable returns while managing risk effectively. The simplicity and prudence of a 50-50 allocation formula, adjusted as needed, form the cornerstone of a sound defensive investment policy. Chapter 4 of this text delves into the foundational principles of portfolio management, emphasizing the importance of aligning investment strategies with one's personal characteristics and circumstances. The chapter opens with a quote from Pat Riley, highlighting the risks of leaving investments to chance. This sets the stage for an exploration of how one's personality and lifestyle should influence their investment approach. The author distinguishes between two primary types of investors, the active or enterprising investor and the passive or defensive investor. Active investing requires continuous research and monitoring of a diverse mix of assets, demanding significant time and intellectual effort. In contrast, passive investing involves creating a stable portfolio that requires minimal intervention but provides less excitement and potentially lower returns. Charles Ellis's insights underscore the physical and intellectual demands of active investing versus the emotional resilience needed for passive investing. The decision on how aggressive a portfolio should be is framed around the individual's lifestyle and temperament. Those with time, a competitive nature, and a penchant for intellectual challenges may prefer active investing. Conversely, those who prioritize simplicity and dislike managing finances might opt for a passive approach. The chapter stresses the importance of self-awareness in choosing and adhering to a strategy that suits one's personality and life circumstances. Graham's advice on asset allocation, particularly the balance between stocks, bonds, and cash, is notable for its timeless relevance. He advises against the conventional wisdom of adjusting risk based on age alone, arguing instead that personal financial situations and future needs should dictate asset allocation. This pragmatic approach challenges traditional rules of thumb, such as the outdated method of subtracting one's age from 100 to determine stock investment proportions. The author also cautions against over-reliance on age-based formulas by providing illustrative scenarios. For instance, an elderly person with substantial wealth and a secure income might benefit more from a higher stock allocation, while a young individual with imminent financial needs might require a more conservative mix. This nuanced view highlights the importance of considering life circumstances and potential financial shocks when determining risk tolerance. Furthermore, the chapter emphasizes the psychological challenges of investing, particularly during market downturns. Many investors struggle to maintain their commitment to stocks when faced with significant losses, often resulting in poor decision-making, such as selling low. Graham's recommendation to maintain a minimum of 25% in bonds provides a cushion against volatility and helps investors stay the course with their stock investments. In discussing practical steps for defensive investors, the chapter outlines considerations for asset allocation based on personal circumstances, such as marital status, children, career risks, and future financial needs. It advocates for a disciplined rebalancing strategy to maintain target asset allocations, suggesting semi-annual adjustments to prevent emotional reactions to market fluctuations. The text also explores the viability of a 100% stock portfolio, deeming it suitable only for a select few who meet stringent criteria, including a long investment horizon and a demonstrated ability to withstand bear markets without panicking. This reinforces the importance of a diversified portfolio to mitigate risks and maintain stability. In terms of income investing, the chapter expands on Graham's original advice by addressing modern investment options. It discusses the relative merits of taxable versus tax-free bonds, the trade-offs between short-term and long-term bonds, and the advantages of bond funds over individual bonds. Additionally, it touches on alternatives like mortgage securities, annuities, preferred stocks, and common stocks with high dividend yields, providing a comprehensive overview of the tools available to today's investors. Overall, Chapter 4 serves as a critical guide for investors, blending timeless wisdom with contemporary insights to help readers craft a personalized investment strategy that aligns with their unique financial goals and risk tolerance. Chapter 5: The Defensive Investor and Common Stocks. Investment Merits of Common Stocks. In the first edition of this work, 1949, a thorough argument was necessary to advocate for a substantial inclusion of common stocks in all investment portfolios. At that time, common stocks were widely seen as speculative and unsafe. The significant decline from the highs of 1946 had paradoxically decreased investor confidence rather than attracting buyers at the more reasonable prices. In the 20 years following, the situation reversed. The significant rise in stock prices made them seem like safe and profitable investments at historically high levels, despite the inherent risks. Our 1949 argument for common stocks rested on two main points. 1. Inflation protection. Common stocks have provided a substantial hedge against inflation, unlike bonds which offer no such protection. Number 2. Higher returns. Historically, common stocks have delivered higher average returns compared to bonds, driven by both higher dividend yields and the underlying growth in market value due to reinvested profits. However, we consistently caution that these benefits can be nullified if stocks are bought at excessively high prices. This was evident in 1929, where it took 25 years for the market to recover to its pre-crash levels. Since 1957, high stock prices have eroded the traditional dividend yield advantage over bonds, and it's uncertain whether inflation and economic growth will compensate for this adverse development in the future. As of late 1971, with the DJIA at 900, we lack enthusiasm for common stocks in general. Despite this, the defensive investor should maintain a significant proportion of common stocks in their portfolio, seeing them as the lesser of two evils compared to an all-bond holding. Rules for the common stock component. For the defensive investor, selecting common stocks should be straightforward. We suggest following these 4 rules. 1. Adequate diversification. Hold between 10 and 30 different stocks. 2. Large, prominent, and conservatively financed companies. Focus on well-established firms with sound financial structures. 3. Long record of continuous dividends. Companies should have a long history of uninterrupted dividend payments, specifically since at least 1950. 4. Price limitations. Avoid paying more than 25 times the average earnings of the past 7 years, or 20 times the earnings of the last 12 months. This rule excludes most growth stocks, which are typically popular but expensive. Growth stocks and the defensive investor. Growth stocks, characterized by their rapid earnings growth and high future growth expectations, are appealing but often come with high price tags. This speculative element adds considerable risk. Notable examples like IBM and Texas Instruments illustrate how even leading growth stocks can experience severe price drops. Therefore, we recommend that defensive investors avoid growth stocks due to their inherent uncertainty and risk. Portfolio changes. Investment portfolios should be periodically reviewed to maintain or improve their quality. Investment counselors and brokerage houses offer such services. Defensive investors should regularly seek advice, but stick to the basic rules of stock selection outlined earlier. Frequent changes should not be necessary if the initial selection was sound. Dollar cost averaging. Dollar cost averaging, where the same amount is invested in stocks monthly, has proven successful historically. Lucille Tomlinson's study shows that this method yielded profits over all tested periods. While some argue that constant investment is impractical, the increasing acceptance of common stocks as part of a sound investment program has mitigated this concern. This approach can complement savings bonds and life insurance, yielding impressive long-term results. The investor's personal situation. Investment choices should align with the investor's circumstances, as illustrated by 3 scenarios. 1. Widow with $200,000 needs to balance income generation with conservatism, possibly splitting her portfolio between bonds and stocks. 2. Doctor with $100,000 savings and $10,000 annual accretions. Choices similar to the widow, but with more flexibility to engage in enterprising investments if desired. 3. Young man earning $200 per week, saving $1,000 a year. Should follow the defensive investor's approach, with some savings in Series E bonds and the remainder in a diversified stock portfolio. Note on the concept of risk. Risk and safety are often misunderstood. The risk involves a permanent loss of value, whereas price fluctuations do not equate to true risk if the investor doesn't sell during a downturn. Properly selected common stocks, even with price volatility, do not carry substantial risk if they provide satisfactory returns over time. Note on the category of large, prominent, and conservatively financed corporations. Defensive investors should focus on companies that are large, prominent, and conservatively financed. While the definitions of these terms can be subjective, guidelines include having substantial assets or revenue and a strong position within their industry. Conservative financing implies that the common stock represents a significant portion of the total capitalization. Arbitrary thresholds like $50 million in assets or revenue are suggested as benchmarks, though these are flexible based on the investor's judgment. Commentary on Chapter 5, A Strategic Approach to Defensive Investing. Benjamin Franklin's observation that human happiness is derived from small, daily advantages rather than rare, significant fortunes sets the tone for the discussion on defensive investing in Chapter 5. This principle underscores the chapter's exploration of how consistent, informed, and strategic actions in investing can yield long-term financial stability and growth, even in the aftermath of severe market downturns. Re-evaluating defensive strategies. The chapter begins by addressing the skepticism many investors feel towards stocks following significant market losses, such as those experienced in the early 2000s. Graham's core argument is emphasized. The degree of defensiveness in an investment strategy should be aligned with the investor's willingness to engage actively with their portfolio, rather than merely their risk tolerance. Graham posits that investing in stocks, when approached correctly, can be as straightforward as managing investments in bonds or cash. The impact of market crashes on risk perception. Market crashes, like the one from 2000 to 2002, often leave investors wary of returning to stocks. However, the text argues that such crashes reduce market risk by bringing stock prices to more reasonable levels. This counterintuitive perspective highlights that past losses should not influence current investment decisions if stocks are priced to provide future growth potential. The chapter asserts that low bond yields further necessitate stock investments, as they offer superior growth prospects despite perceived risks, embracing ease of stock investment. For the defensive investor, the modern investment landscape offers unprecedented ease and efficiency. Setting up an automated investment plan, such as a stock market index fund, allows for consistent, minimal effort engagement with the market. This approach not only simplifies the process, but also ensures disciplined investing free from emotional decision-making. The pitfalls of buy what you know. A critical section of the chapter dissects the popular investment adage, buy what you know, popularized by Peter Lynch. While Lynch's advice taps into the intuitive advantage of familiar investments, the chapter warns against complacency and the illusion of knowledge. The example of Enron and similar corporate disasters underscores the risks of overconfidence and inadequate research. Investors are cautioned against relying solely on personal experience and are urged to rigorously analyze financial statements and market positions. Practical solutions for defensive investors. The chapter provides practical guidance for defensive investors, emphasizing the value of diversified and automated investment strategies. Online brokerages and direct stock purchase programs offer accessible and low-cost entry points for individual investors. However, detailed record keeping and a commitment to diversification are essential to avoid tax complications and undue risk exposure. Autopilot portfolios and dollar cost averaging. For those seeking a hands-off approach, the chapter advocates for dollar cost averaging into a diversified portfolio, particularly through index funds. This method mitigates the impact of market volatility and ensures regular investment without the need for market timing. Historical data is presented to illustrate the efficacy of this strategy, even during the Great Depression. Conclusion: embracing uncertainty. Ultimately, Chapter 5 emphasizes that defensive investors should embrace the uncertainty of financial markets with a strategy that balances risk and effort. By creating a diversified, automated investment plan, investors can achieve steady growth while mitigating emotional and speculative pitfalls. This approach allows investors to confidently navigate market fluctuations with the powerful mindset of "I don't know and I don't care," focusing on long-term stability rather than short-term gains. Chapter 6: Portfolio Policy for the Enterprising Investor, Negative Approach. Introduction. An enterprising or aggressive investor should start with the same foundational principles as a defensive investor, dividing funds between high-grade bonds and high-grade common stocks purchased at reasonable prices. However, the aggressive investor will venture into other types of securities, requiring strong justifications for each departure. Given the broad scope of aggressive investment choices, the selection will largely depend on the investor's competencies, equipment, interests, and preferences. General guidelines for the enterprising investor. The most valuable guidelines for the enterprising investor are largely negative. 1. Avoid high-grade preferred stocks. These are best left to corporate buyers. 2. Avoid inferior bonds and preferred stocks. These should be considered only if available at substantial discounts, typically at least 30% under par for high-coupon issues. 3. Steer clear of foreign government bonds. Even if yields are attractive, they present significant risks. 4. Be cautious with new issues. This includes convertible bonds, preferred stocks, and common stocks with recent excellent earnings. Standard bond investments. For standard bond investments, the aggressive investor should follow the defensive investor's pattern, choosing between high-grade taxable bonds yielding around 7.25% and good quality tax-free bonds yielding up to 5.30% on longer maturities. Second-grade bonds and preferred stocks. In late 1971, the yields on first-rate corporate bonds made it impractical to buy second-grade issues solely for higher returns. Poor credit corporations could not sell non-convertible bonds to the public, resorting instead to convertible bonds or bonds with warrants. Thus, non-convertible bonds of inferior rating typically represent older issues sold at significant discounts, offering potential substantial gains if credit ratings improve and general interest rates decline. However, well-entrenched obligations with old-style coupon rates also offered competitive opportunities for income and appreciation. Historical and practical considerations. Experience shows that purchasing second-grade bonds and preferred stocks at full prices is unwise due to their susceptibility to severe price declines during bad markets. These issues often suffer from reduced principal value despite potentially high yields. Historically, second-grade bonds experienced significant price collapses during market downturns, outpacing the declines in high-quality common stocks. Foreign government bonds. Investors should be wary of foreign government bonds due to their poor historical performance since 1914, exacerbated by global conflicts and depressions. Even well-regarded foreign bonds like those of Australia or Norway carry risks, especially when economic or political instability arises. The inability to enforce claims on foreign obligations further discourages investment in these bonds. New issues. Generally, investors should be cautious with new issues, which often come with strong salesmanship and are sold under favorable conditions for the issuer, not the buyer. This is particularly true for lower-grade bonds and preferred stocks, which may not withstand market downturns or meet performance expectations over the long term. New common stock offerings. New common stock offerings, particularly from privately owned enterprises, often lead to significant investor losses. Historically, these offerings become prevalent during bull markets, with many small and lower quality companies entering the public market. Initial profits may be seen, but subsequent price collapses are common. Investors are advised to resist the temptation of new issues during bullish periods, as these often do not withstand rigorous quality and value tests and can result in substantial losses. Conclusion. The enterprising investor should adopt a cautious approach, focusing on well-justified securities and avoiding those with inherent high risks, even if they offer attractive yields. By adhering to these principles, the aggressive investor can better navigate the complexities and potential pitfalls of a more dynamic investment strategy. Commentary on Chapter 6. The punches you miss are the ones that wear you out. Boxing trainer Angelo Dundee. In Chapter 6, the core principle is that an investor's restraint can be just as crucial as their actions. Benjamin Graham emphasizes the importance of knowing what to avoid, particularly for aggressive investors. This chapter is a guideline on what not to do, reflecting on various investment strategies and tools that are often pitfalls for the unwary. Junkyard dogs? Graham strongly advises against high-yield or junk bonds, which he refers to as second-grade or lower-grade bonds. In his era, diversifying these bonds to mitigate default risk was too complex and expensive for individual investors. Today, the existence of over 130 mutual funds specializing in junk bonds somewhat addresses this diversification issue. These funds purchase large quantities of different bonds, reducing individual risk. Despite this, Graham's caution against high-yield preferred stock remains relevant due to the lack of a cost-effective diversification strategy for these instruments. Historical data reveals that while junk bonds have a higher default rate, 4.4% annually since 1978, they have also yielded substantial returns, 10.5% annually, compared to 8.6% for 10-year U.S. Treasury bonds. However, the high fees and poor principal preservation by many junk bond funds make them a risky choice. They may suit retirees needing extra income who can endure value fluctuations, or financial sector employees seeking a hedge against rising interest rates, but should only be a minor component in an intelligent investor's portfolio. A world of hurt for WorldCom bonds. Using WorldCom as a cautionary tale, the text illustrates the dangers of investing in bonds solely for their yield. Despite attractive yields, a brief examination of WorldCom's financials showed that it was incapable of covering its interest payments without further borrowing, leading to its eventual bankruptcy. Investors in these bonds suffered significant losses, demonstrating that no yield is high enough to justify the risk of such financial instability. The vodka and burrito portfolio. Graham also dismisses foreign bonds as viable investments. However, modern mutual funds that focus on bonds from emerging markets like Brazil, Mexico, and Nigeria offer potential benefits for those with a high risk tolerance. These bonds do not typically correlate with U.S. stock market movements, providing a potential buffer during market downturns. Nonetheless, they should constitute a small fraction of a diversified bond portfolio due to their high risk. Dying a trader's death. Chapter 6 also delves into the pitfalls of day trading, emphasizing that frequent trading erodes returns through both direct costs and tax implications. The narrative is supported by a study from finance professors Brad Barber and Terrence Odion, showing that active traders significantly underperform the market after accounting for trading costs, whereas patient investors who trade minimally tend to outperform slightly. The early bird gets wormed. The chapter concludes with a critique of the IPO, initial public offering craze. Despite the allure of substantial gains from IPOs like Microsoft, the reality is that most IPOs do not perform well. Studies show that IPOs typically underperform the market when bought at the first closing price and held for 3 years. Furthermore, the most significant gains are often reaped by insiders and institutional investors who access shares at initial prices, leaving individual investors with suboptimal results. Graham's advice underscores the importance of focusing on the intrinsic value of investments rather than their popularity. The example of VA Linux, which skyrocketed on its first trading day only to plummet in value, serves as a stark reminder of the dangers of investing based on hype rather than fundamental value. Conclusion. Chapter 6 of Graham's work is a guide on what aggressive investors should avoid, reinforcing the idea that avoiding mistakes is just as critical as making wise investments. From junk bonds to day trading and IPOs, Graham's advice remains pertinent, urging investors to focus on long-term value and to be wary of the high risks associated with these investment strategies. Chapter 7 of this investment guide delineates the portfolio policy tailored for the enterprising investor, focusing on strategies to achieve superior investment outcomes. The chapter encompasses various dimensions, including bond investments, common stock operations, growth stock approaches, market timing, and the identification of bargain opportunities. Bond investments for the enterprising investor are outlined, encompassing tax-free municipal bonds with government backing, taxable new community bonds, and tax-free industrial bonds serviced by reputable corporations. Special attention is drawn to unique bond opportunities and lower quality bonds available at discounted prices, which may align with the investor's appetite for distinct investment avenues. In the domain of common stocks, the enterprising investor is encouraged to engage in astute practices, including buying in low markets and selling in high markets, selecting carefully chosen growth stocks, identifying bargain issues, and capitalizing on special situations. The chapter underscores the importance of a nuanced approach to stock market engagement, highlighting the challenges associated with market timing and the limitations of relying solely on past performance as a predictor of future success. The growth stock approach is dissected, with an emphasis on the complexities involved in identifying companies poised for sustained outperformance. Despite the allure of growth stocks, the chapter cautions against overpaying for perceived prosperity and underscores the need for a balanced assessment of future prospects. A compelling argument is made for the identification and exploitation of bargain opportunities in the stock market. The chapter delineates methods for detecting undervalued stocks based on objective criteria such as earnings potential and asset value, with a particular focus on larger companies experiencing temporary unpopularity. Furthermore, the chapter explores the dynamics of secondary companies, delineating how market perceptions often undervalue such entities, presenting opportunities for savvy investors to profit from their eventual reevaluation. The narrative encompasses historical market trends, the impact of market cycles on investment opportunities, and the potential rewards of acquiring undervalued assets, including bonds and preferred stocks, in times of market distress. In sum, Chapter 7 offers a comprehensive roadmap for the enterprising investor, emphasizing the importance of discernment, patience, and a contrarian mindset in navigating the intricacies of the investment landscape to achieve superior long-term returns. Special situations, commonly referred to as workouts in financial circles, represent a nuanced field of investment strategy that historically yielded attractive returns to adept practitioners. In the past, mastering these intricacies often promised profitable outcomes, irrespective of prevailing market conditions, and was not strictly exclusive to seasoned professionals, as individuals with a knack for the craft could swiftly grasp its dynamics. The genesis of special situations largely emanates from the trend of larger corporations acquiring smaller firms, a strategic move driven by the impetus for diversification in product portfolios. Such acquisitions necessitate offering prices above current market levels to secure shareholder approval, presenting a fertile ground for profit-seeking investors with astute judgment and ample experience. Historically, substantial profits were garnered by astute investors through strategic investments in distressed assets, such as railroad bonds during bankruptcy proceedings, or the dissolution of public utility holding companies following regulatory mandates. These scenarios often created opportunities for arbitrage and profit realization due to market inefficiencies, as securities embroiled in complex legal proceedings tended to be undervalued, presenting bargains for discerning investors. However, the landscape of special situations investing has evolved, becoming riskier and less lucrative in recent years, attributing to various factors. While the potential for future resurgence in the profitability of this field remains plausible, It currently demands a specialized skill set and mindset, making it a niche pursuit unsuitable for mainstream investment strategies. In delineating investment policy, a fundamental dichotomy arises between the defensive, passive approach and the aggressive, enterprising stance. The defensive investor, constituting the majority, typically lacks the requisite expertise, time, or inclination for active investment strategies, and is better served by adhering to conservative portfolio allocations. Conversely, the enterprising investor, equipped with sufficient knowledge and judgment, may engage in a broader spectrum of investment activities, albeit grounded in sound business principles. The exclusion of certain securities, such as foreign bonds, ordinary preferred stocks, and secondary common stocks, from recommended investment categories underscores the pragmatic stance advocated herein. While aggressive investors may opportunistically capitalize on these assets at bargain prices, defensive investors are cautioned against such endeavors, as they may lack the acumen or risk tolerance to navigate these volatile markets effectively. In essence, the delineation between primary and secondary companies and the corresponding investment strategies underscores the importance of discernment in portfolio construction. While the investment thesis may allow for some flexibility in assessing individual securities, the overarching classification of investors into defensive or aggressive categories remains paramount, safeguarding against undue risk exposure and aligning with one's investment objectives and temperament. Chapter 7 of this insightful piece delves into the intricate dance between market timing, growth stock investment, and the perils of overconcentration. Utilizing poignant examples and seasoned wisdom, it navigates the treacherous waters of investment strategy with a blend of historical context and contemporary analysis. The chapter commences by addressing the elusive art of market timing, a pursuit often romanticized but seldom mastered. Through anecdotes featuring prominent figures such as Alan Greenspan and Kate Leary Lee, it underscores the inherent fallibility of attempting to predict market movements with any semblance of reliability. By juxtaposing retrospective clarity with the fog of real-time decision-making, it convincingly argues that market timing is more a feat of hindsight than foresight, rendering it an impractical endeavor for the majority of investors. Transitioning to the realm of growth stocks, the narrative delves into the seductive allure of rapid expansion, juxtaposed against the sobering reality of valuation. Through a meticulous examination of iconic growth companies like General Electric, Home Depot, and Sun Microsystems, it elucidates the inverse relationship between growth trajectory and stock affordability. This section adeptly illustrates Benjamin Graham's timeless adage that a great company does not necessarily equate to a great investment if purchased at an exorbitant price. Moreover, the chapter ventures into the perilous territory of overconcentration, drawing upon historical precedents and contemporary anecdotes to underscore the inherent risks of putting all eggs in one basket. By dissecting the Forbes 400 list and contrasting the trajectories of diversified versus concentrated fortunes, it elucidates the fine line between concentrated success and catastrophic failure. Through this exploration, it reinforces the prudence of diversification as a safeguard against unforeseen market upheavals and industry downturns. Concluding with a discourse on the merits of international diversification, the chapter urges readers to transcend parochialism and embrace the global marketplace. By recounting the cautionary tale of Japanese investors during the 1980s, it emphasizes the importance of hedging against domestic economic volatility through exposure to foreign markets. This section serves as a poignant reminder that while home bias may offer a sense of familiarity, it also entails significant risk in an increasingly interconnected world. In sum, Chapter 7 offers a masterful blend of historical insight, empirical evidence, and pragmatic wisdom, guiding investors through the labyrinthine terrain of market timing, growth stock investing, and portfolio diversification with erudition and clarity. Chapter 8: The Investor and Market Fluctuations. Understanding market impact on investments. Investors who allocate funds to high-grade short-term bonds, 7 years or less, are minimally impacted by market price fluctuations. This stability extends to holdings in U.S. savings bonds, which can be redeemed at their cost price or higher. In contrast, long-term bonds and common stock portfolios are prone to significant price variations over time. Awareness and preparedness for these fluctuations are crucial, both financially and psychologically. Speculative risks and investor behavior. Investors naturally aim to benefit from market changes, hoping for an increase in stock value and potentially capitalizing on advantageous buying and selling opportunities. However, this pursuit carries the risk of speculative behavior. While it is easy to advise against speculation, adhering to this advice is challenging. If an investor chooses to speculate, it is essential to do so with a clear understanding of the potential for loss, limiting the risk and segregating it from their core investment strategy. Strategies for managing market fluctuations. 1. Price changes in common stocks. The historical analysis of stock market behavior over the past century, detailed in Chapter 3, provides insight into potential long-term appreciation of a relatively stable portfolio and the strategy of buying during bear markets and selling during bull markets. Nub 2. Market fluctuations as investment guides. Given the wide price fluctuations in investment-grade common stocks, intelligent investors can potentially profit by understanding these swings. Two main approaches are timing, anticipating market trends to buy or hold during uptrends and sell or refrain from buying during downtrends. Pricing, buying stocks when they are undervalued and selling when they are overvalued. A conservative approach is to ensure not overpaying for stocks, which suffices for defensive investors focusing on long-term holdings. While pricing can yield satisfactory results, an emphasis on market timing often leads to speculative outcomes. Wall Street traditionally advocates for market forecasting, but skepticism grows further from its influence, as the general public typically cannot outpace market movements. Limitations of market timing. The psychological importance of quick profits drives speculators to favor timing. However, investors benefit only if they can repurchase shares at significantly lower prices after waiting periods, balancing out any lost dividend income. Historical market strategies, Dow theory and buy low, sell highs. The Dow theory, once a reliable method for market timing, demonstrated diminishing effectiveness as it gained popularity. Similarly, the buy low, sell high strategy, effective in earlier market cycles, 1900 to 1950, proved unreliable in the evolving market post-1949. Formula plans and investment cycles. Formula plans, which involve selling stocks during substantial market rises and buying during declines, gained traction but often led to missed opportunities as markets ran away from investors. Like the Dow theory, their success waned as they gained popularity. Handling portfolio fluctuations. Investors should expect and accept significant value fluctuations in their common stocks over time. Longer-term and wider market changes present practical and psychological challenges. A mechanical method to adjust the stock-bond ratio in a portfolio helps manage emotions and actions during market highs and lows. Evaluating stocks beyond market prices. Investors should view their stocks as business ownership shares, focusing on underlying business value rather than market price fluctuations. Successful companies often trade above their book value, requiring reliance on market validation of their stock prices. Practical recommendations for conservative investors. Conservative investors should focus on stocks priced close to their tangible asset values, supplemented by satisfactory earnings ratios and strong financial positions. This approach provides a buffer against market volatility and opportunities to capitalize on market mispricings. In summary, managing market fluctuations requires a balanced approach, combining awareness of speculative risks, strategic adjustments to investment proportions, and a focus on underlying business values rather than market prices alone. The Great Atlantic and Pacific Tea Company, a case study in market dynamics and investor behavior. The Great Atlantic and Pacific Tea Co., A&P, offers a compelling illustration of corporate and investment dynamics, reflecting the multifaceted nature of market perceptions and valuations over time. This example spans several decades, highlighting both the erratic nature of stock market valuations and the critical lessons for investors. Initial market introduction and early volatility. A&P shares began trading on the CURB market, now known as the American Stock Exchange, in 1929. The stock initially reached a high of 494, but by 1932, during the Great Depression, it had plummeted to 104, despite the company maintaining nearly the same level of earnings. By 1936, the stock traded between 111 and 131, only to crash to 36 in the 1938 recession. Market misvaluation in 1938. The 1938 stock price of 36 was extraordinarily low, with the company valued at $126 million, despite holding $85 million in cash and $134 million in working capital. A&P was the largest retail enterprise in the United States, yet its market valuation fell below its net current assets, suggesting the market viewed the company as worth more in liquidation than as a going concern. This undervaluation was driven by fears of special taxes on chain stores, a drop in net profits, and a generally depressed market, factors that were either exaggerated or temporary. Investor perspective and market turnaround. An investor who purchased A&P stock in 1937 at approximately 80, 12 times the 5-year average earnings, would have seen the value drop to 36 in 1938. This decline, while significant, should not have prompted panic if the investor's analysis confirmed no substantial deterioration in the company's intrinsic value. Indeed, by 1939, the stock price rebounded to 170.5, tripling from its 1938 low and surpassing the 1937 average. Long-term performance and overvaluation. A&P shares continued to rise post-1949, reaching an equivalent of 705 for the 1938 shares by 1961, following a 10-for-1 stock split. However, the 1961 valuation at 30 times earnings was driven by unrealistic growth expectations. This optimism was unfounded, as subsequent earnings declined, leading to a sharp drop in stock price to 34 by the following year. By 1970, the stock hit a low of 21.5 and further decreased to 18 in 1972, as the company faced its first quarterly loss. Lessons and investor takeaways. The A&P case underscores the volatility and potential miscalculations inherent in stock market valuations. In 1938, the company was undervalued despite strong fundamentals, while in 1961 it was overvalued based on unrealistic growth expectations. Investors should note 2 primary lessons. 1. Market prices and fundamental value. The stock market can significantly misprice companies, sometimes offering astute investors opportunities to buy undervalued stocks or sell overvalued ones. An investor's success often hinges on recognizing these discrepancies and acting accordingly. 2. Business evolution and investment monitoring. Businesses change over time, often for the worse. Investors must periodically reassess their holdings to ensure the companies remain fundamentally sound. The example of A&P highlights the importance of maintaining a disciplined, value-oriented investment strategy and avoiding overreaction to market fluctuations. Investors are best served by focusing on intrinsic business values rather than short-term market movements, treating stocks as partial ownership in real businesses rather than mere tradable securities. Commentary on Chapter 8, Dr. Jekyll and Mr. Market. Happiness and Wisdom in Investing. Marcus Aurelius's quote, "The happiness of those who want to be popular depends on others. The happiness of those who seek pleasure fluctuates with moods outside their control, but the happiness of the wise grows out of their own free acts," underscores a core principle in investing: independence of thought and action. This wisdom is crucial when engaging with the stock market, as it requires an investor to remain detached from the capricious sentiments of the market, often personified as the erratic Mr. Market. The Parable of Mr. Market. Benjamin Graham's metaphor of Mr. Market serves as a compelling illustration of market psychology. Mr. Market is characterized as a manic depressive entity whose valuations of stocks swing between irrational exuberance and undue pessimism. This personification helps investors understand the importance of not being swayed by market emotions, but rather focusing on the intrinsic value of stocks. The narrative of Inktomi Corp., whose stock soared to irrational heights only to crash precipitously, exemplifies Mr. Market's volatile nature. The Inktomi Case Study. The rise and fall of Inktomi Corp. in the early 2000s is a vivid case study of market mania. At its peak, Despite chronic unprofitability, Inktomi was valued at $25 billion due to Mr. Market's irrational exuberance. This bubble burst spectacularly, with the stock plummeting to a fraction of its peak value. This stark fluctuation highlights the disconnection between market price and business fundamentals, illustrating the dangers of following market sentiments blindly. Learning to think independently. Investors often succumb to Mr. Market's mood swings, adjusting their behavior based on market highs and lows. This herd mentality can lead to poor investment decisions, such as reducing contributions to retirement plans when stocks are cheap and increasing them when stocks are overpriced. The key takeaway is the importance of independent thinking and the discipline to resist the crowd's irrational behavior. Harnessing Mr. Market's volatility. While it is crucial not to follow Mr. Market blindly, it is also important not to ignore him entirely. Intelligent investors should use Mr. Market's erratic price offerings to their advantage, buying undervalued stocks during market lows and being cautious during market highs. This approach transforms Mr. Market from a master into a servant, where his mood swings provide opportunities for astute investors. Professional investors versus individual investors. Professional investors face constraints that individual investors do not, such as the need to match or beat benchmarks and manage large funds, which can lead to suboptimal investment decisions. Individual investors have the freedom to think long-term, diversify, and avoid the pressures of short-term performance metrics. By focusing on controllable factors like costs, risk, and behavior, individual investors can potentially achieve better outcomes than professionals who are often forced to follow market trends. Psychological challenges and behavioral discipline. Investors' brains are wired to seek patterns and react emotionally to gains and losses. This tendency can lead to irrational behavior, such as chasing after rising stocks or panic selling during downturns. Understanding this psychological predisposition helps investors recognize the importance of behavioral discipline. Strategies such as dollar-cost averaging and maintaining a long-term perspective can mitigate the impact of Mr. Market's fluctuations. Embracing market downturns. Contrary to common fear, market downturns present opportunities for long-term investors to buy undervalued stocks. By adopting a mindset that views falling prices as buying opportunities rather than losses, investors can benefit from market cycles. This approach aligns with Graham's teaching that stocks should be viewed as part of a long-term strategy rather than short-term speculation. Tax strategies and loss harvesting. One practical strategy during bear markets is tax loss harvesting, where investors sell losing stocks to offset gains and reduce taxable income. This tactic not only helps in managing tax liabilities, but also provides an opportunity to reinvest in the same or similar stocks at lower prices, effectively benefiting from Mr. Market's irrationality. Investment discipline and long-term contracts. To solidify this disciplined approach, investors can use an investment owner's contract to commit to regular, long-term investing, resisting the urge to react to market volatility. This contract emphasizes the importance of consistent investment, regardless of market conditions, and reinforces the commitment to a long-term financial plan. In summary, Chapter 8 provides a comprehensive framework for understanding market psychology, the pitfalls of herd behavior, and the strategies for maintaining independent, disciplined investment practices. By learning from historical market episodes and applying behavioral finance principles, investors can better navigate the complexities of Mr. Market's moods and achieve their financial goals. Chapter 9, Investing in Investment Funds. Introduction to Investment Funds. Investment funds provide an accessible option for the defensive investor. These funds, which pool money from numerous investors to purchase securities, come in two primary forms. 1. Mutual funds, open-end funds. Shares are redeemable on demand at the net asset value, NAV. These funds actively sell additional shares through sales teams. 2. Closed-end funds. Shares are non-redeemable, with a fixed number of shares that trade on the market like regular stocks. Both types are regulated by the Securities and Exchange Commission, SEC. Size and classification. As of the end of 1970, there were 383 registered investment funds with total assets of $54.6 billion. These funds can be categorized by their portfolio composition and investment objectives. Balanced funds, significant portion in bonds, about 1/3. Stock funds, predominantly common stocks. Other varieties include bond funds, hedge funds, etc. Funds can also be distinguished by their sales methods. Load funds include a sales charge around 9% of NAV. No load funds, no sales charge, relying on management fees. Tax treatment and fund structure. Most funds operate under tax laws that prevent double taxation, requiring them to distribute nearly all their ordinary income and capital gains to shareholders. Some funds have introduced dual-purpose structures with separate classes for income and capital gains. Investor considerations. Investors face a broad array of choices, raising several critical questions. 1. Can the investor achieve better than average results by selecting the right funds? 2. How can the investor avoid funds that underperform? 3. What are the merits of different types of funds, e.g., balanced versus stock, open-end versus closed-end, load versus no load? Industry performance overview. The fund industry has generally served investors well, promoting good investment habits and providing returns comparable to the overall market. For the average investor, mutual funds might have provided better outcomes than direct stock investments, despite similar aggregate performance and potentially higher costs. Fund performance analysis. Analyzing the performance of the 10 largest stock funds from 1961 to 1970 reveals that they performed on par with the Standard & Poor's 500 stock composite average and better than the Dow Jones Industrial Average, DJIA. The variability in individual fund performance underscores the difficulty in selecting consistently superior funds. The rise and fall of performance funds. The 1960s saw the emergence of performance funds, managed with a focus on achieving exceptional returns. Initially successful, these funds eventually faced significant losses due to speculative investments and inexperience among young managers. The Manhattan Fund exemplifies the risks with dramatic initial gains followed by notable declines and investments in companies that later faced bankruptcy. Investment strategy recommendations. Investors are advised to be cautious of funds that promise extraordinary returns. Long-term, well-managed funds typically provide stable, though not spectacular, performance. Closed-end versus open-end funds. Closed-end funds often trade at a discount to their NAV, offering potentially higher returns compared to open-end funds sold at a premium. Despite concerns about price fluctuations, historical data suggests that closed-end funds can provide superior returns when bought at a discount. Balanced funds. Balanced funds, which hold a mix of stocks and bonds, offer lower income returns compared to direct bond investments. Investors might achieve better results by separately managing their bond portfolios with high-quality bonds or tax-free bonds. In summary, while investment funds offer a range of options for defensive investors, careful selection and a clear understanding of the different types and their performance histories are crucial for achieving satisfactory results. Commentary on Chapter 9, Insights into Mutual Fund Investing. The introductory joke in Chapter 9 serves as a humorous yet insightful preamble, emphasizing practical knowledge over theoretical understanding. Billy Bob's understanding of his sheep, despite his poor grasp of subtraction, parallels the core message of the chapter. Practical, experiential knowledge in investing often trumps theoretical expectations. Mutual funds, an almost perfect investment vehicle. Mutual funds, a quintessential American innovation introduced by Edward G. Loeffler in 1924, have democratized investing. These funds are characterized by their affordability, convenience, professional management, and stringent regulation under federal securities law. They have significantly broadened participation in the investment world, enabling millions of American families and global investors to engage in the financial markets. However, mutual funds are not without flaws. Their imperfections often lead to underperformance relative to the market, high fees, tax inefficiencies, and volatile returns. Therefore, intelligent investors must meticulously select funds to avoid potential pitfalls and ensure their investments align with their financial goals. The misguided pursuit of top performers. A common mistake among investors is chasing after funds that have recently shown stellar performance, assuming this trend will continue. This behavior stems from an innate human tendency to believe that short-term success predicts long-term outcomes. However, in financial markets, luck often plays a more significant role than skill. The chapter illustrates this with the example of the hottest funds of 1999, which eventually underperformed, highlighting the inherent unpredictability of market sectors. The folly of relying solely on past performance is underscored by academic research indicating several consistent findings. Most funds fail to pick stocks effectively enough to cover their costs. High expenses correlate with lower returns. Frequent trading diminishes earnings, and high volatility persists. Thus, choosing future top-performing funds based on historical performance is nearly impossible, akin to expecting Bigfoot to appear at a social event. The intelligent approach to mutual fund investing. Understanding the difficulty in finding consistently good funds helps investors make more informed decisions. Despite the challenge, certain strategies can improve the odds of selecting beneficial funds. 1. Managerial investment. Funds where managers are significant shareholders align the manager's interests with those of the investors, reducing conflicts and enhancing performance incentives. 2. Low expenses. Funds with low operating costs tend to perform better over time as high fees erode returns. 3. Unique strategies. Funds that adopt distinct investment strategies diverging from the mainstream often outperform by capitalizing on overlooked opportunities. 4. Capacity constraints. Funds that close to new investors at appropriate times avoid asset bloat, which can compromise performance. 5. Low advertising. Funds that do not aggressively market themselves often focus more on performance than on gathering assets. Index funds. A reliable alternative. Given the difficulties inherent in active fund management, index funds, which aim to replicate market performance rather than beat it, offer a robust alternative. Their low costs and passive management style make them attractive for long-term investors. Despite their lack of excitement, index funds' cost advantages compound over time, leading to superior performance compared to most actively managed funds. The risks of overconfidence and short-term focus. Investors' overconfidence and the tendency to make short-term decisions based on recent performance can lead to suboptimal outcomes. Historical data shows that poor-performing funds rarely become winners, and emotional reactions to market fluctuations often result in buying high and selling low. Therefore, maintaining a disciplined, patient approach is crucial. Closed-end funds and exchange-traded funds, ETFs. While closed-end funds have diminished in popularity, they can still offer value, particularly when trading at a discount. ETFs, on the other hand, provide a modern alternative, combining the benefits of index funds with the flexibility of stock trading, albeit with considerations regarding transaction costs. When to sell a fund. Deciding when to sell a fund should be based on clear indicators such as strategic shifts, rising expenses, high tax liabilities, and erratic performance. Investors should avoid making decisions based on short-term underperformance, which often reflects temporary market conditions, rather than a fundamental flaw in the fund's strategy. Conclusion. Chapter 9 offers a comprehensive examination of mutual fund investing, blending practical advice with empirical evidence. The emphasis on low costs, unique strategies, and managerial alignment, coupled with a cautious approach to past performance, provides a solid foundation for making intelligent investment decisions. By prioritizing long-term discipline and understanding the inherent challenges in fund selection, investors can navigate the complexities of the mutual fund landscape effectively. Commentary on Chapter 9: Insights into Mutual Fund Investing. The introductory joke in Chapter 9 serves as a humorous yet insightful preamble, emphasizing practical knowledge over theoretical understanding. Billy Bob's understanding of his sheep, despite his poor grasp of subtraction, parallels the core message of the chapter. Practical, experiential knowledge in investing often trumps theoretical expectations. Mutual funds, an almost perfect investment vehicle. Mutual funds, a quintessential American innovation introduced by Edward G. Loeffler in 1924, have democratized investing. These funds are characterized by their affordability, convenience, professional management, and stringent regulation under federal securities law. They have significantly broadened participation in the investment world, enabling millions of American families and global investors to engage in the financial markets. However, mutual funds are not without flaws. Their imperfections often lead to underperformance relative to the market, high fees, tax inefficiencies, and volatile returns. Therefore, intelligent investors must meticulously select funds to avoid potential pitfalls and ensure their investments align with their financial goals. The misguided pursuit of top performers. A common mistake among investors is chasing after funds that have recently shown stellar performance, assuming this trend will continue. This behavior stems from an innate human tendency to believe that short-term success predicts long-term outcomes. However, in financial markets, luck often plays a more significant role than skill. The chapter illustrates this with the example of the hottest funds of 1999, which eventually underperformed, highlighting the inherent unpredictability of market sectors. The folly of relying solely on past performance is underscored by academic research indicating several consistent findings. Most funds fail to pick stocks effectively enough to cover their costs. High expenses correlate with lower returns, frequent trading diminishes earnings, and high volatility persists. Thus, choosing future top-performing funds based on historical performance is nearly impossible, akin to expecting Bigfoot to appear at a social event. The intelligent approach to mutual fund investing. Understanding the difficulty in finding consistently good funds helps investors make more informed decisions. Despite the challenge, certain strategies can improve the odds of selecting beneficial funds. 1. Managerial investment. Funds where managers are significant shareholders align the manager's interests with those of the investors, reducing conflicts and enhancing performance incentives. 2. Low expenses. Funds with low operating costs tend to perform better over time, as high fees erode returns. 3. Unique strategies. Funds that adopt distinct investment strategies, diverging from the mainstream, often outperform by capitalizing on overlooked opportunities. 4. Capacity constraints. Funds that close to new investors at appropriate times avoid asset bloat, which can compromise performance. 5. Low advertising. Funds that do not aggressively market themselves often focus more on performance than on gathering assets. Index funds, a reliable alternative. Given the difficulties inherent in active fund management, index funds, which aim to replicate market performance rather than beat it, offer a robust alternative. Their low costs and passive management style make them attractive for long-term investors. Despite their lack of excitement, index funds' cost advantages compound over time, leading to superior performance compared to most actively managed funds. The risks of overconfidence and short-term focus. Investors' overconfidence and the tendency to make short-term decisions based on recent performance can lead to suboptimal outcomes. Historical data shows that poor-performing funds rarely become winners, and emotional reactions to market fluctuations often result in buying high and selling low. Therefore, maintaining a disciplined, patient approach is crucial. Closed-end funds and exchange-traded funds, ETFs. While closed-end funds have diminished in popularity, they can still offer value, particularly when trading at a discount. ETFs, on the other hand, provide a modern alternative, combining the benefits of index funds with the flexibility of stock trading, albeit with considerations regarding transaction costs. When to sell a fund. Deciding when to sell a fund should be based on clear indicators, such as strategic shifts, rising expenses, high tax liabilities, and erratic performance. Investors should avoid making decisions based on short-term underperformance, which often reflects temporary market conditions, rather than a fundamental flaw in the fund's strategy. Conclusion. Chapter 9 offers a comprehensive examination of mutual fund investing, blending practical advice with empirical evidence. The emphasis on low costs, unique strategies, and managerial alignment, coupled with a cautious approach to past performance, provides a solid foundation for making intelligent investment decisions. By prioritizing long-term discipline and understanding the inherent challenges in fund selection, investors can navigate the complexities of the mutual fund landscape effectively. Chapter 10: The Investor and His Advisors. The investment of money in securities is a distinct business operation often guided by external advice. Most investors are amateurs, relying on professionals for guidance. This reliance is unique as it involves seeking advice on how to make money, a responsibility typically reserved for the business owner in other fields. This dependency on advice underscores the need for investors to carefully consider their sources of guidance. Understanding the role of investment advisors. Investment advisors can help investors achieve standard income results by leveraging their superior training and experience to avoid mistakes and secure the expected returns. However, when investors seek above-average returns, the reliability of these advisors comes into question. Sources of investment advice. Investors can seek advice from various sources: knowledgeable relatives or friends, local bankers, brokerage firms, financial services or periodicals, and professional investment counselors. This diversity in sources indicates a lack of a systematic approach to investment advice among investors. Common sense considerations. Investors relying primarily on external advice should limit themselves and their advisors to standard, conservative investments unless they possess a deep and favorable understanding of the person guiding them towards more unconventional investments. This approach helps maintain the investor's security until they gain sufficient knowledge and experience to make independent judgments, transitioning from a defensive to an aggressive investor. Investment counsel and trust services. Professional investment counselors, who charge substantial annual fees, tend to be conservative in their investment strategies, focusing on standard interest and dividend-paying securities. Their main aim is to conserve principal value and produce a reasonable rate of income. They excel in shielding clients from costly mistakes, providing reliable guidance expected by a defensive investor. Financial services. Financial services offer periodic bulletins and advice on market conditions and individual securities. These services cater to those managing their financial affairs or advising others, providing information to supplement personal decision-making. However, their market forecasts are often hedged and not highly reliable. Instead, their value lies in the substantial economic intelligence they offer, which aids in creating rational stock and bond prices. Advice from brokerage houses. Stockbrokers, particularly members of stock exchanges, provide a significant volume of information and advice. While some brokerage firms strive to refrain from encouraging speculation, the inherent profit-driven nature of the business often leans towards speculative advice. Customers, brokers, and financial analysts serve different roles, with the latter providing detailed studies and expert opinions on securities. Investors should engage with these professionals carefully, ensuring their advice aligns with a value-minded rather than a speculative approach. Investment bankers involved in underwriting and selling new issues serve a dual role as advisors and salesmen. They facilitate the supply of new capital for industry expansion. However, individual investors should critically assess their recommendations, as these often cater to less experienced buyers and may be driven by speculative interests during active markets. Other advisors. Consulting local bankers can provide conservative and steadying advice, especially valuable for less experienced investors. However, seeking advice from relatives or friends can be unreliable, as lay advisors often lack the necessary expertise. Summary. Investors willing to pay for professional management should select reputable investment counsel firms or trust companies. For most investors who obtain advice without specific fees, expectations should align with average results. Defensive investors should clearly state their preferences for high-grade bonds and leading corporation stocks, ensuring prices are reasonable by past standards. Aggressive investors should actively collaborate with their advisors, insisting on detailed explanations and maintaining an independent judgment. To safeguard investments, investors are advised to use banks for security transactions, especially given the recent financial troubles in brokerage firms. Commentary on Chapter 10. Michel de Montaigne's reference to the Milesian wench who cautioned Thales to pay attention to his immediate surroundings rather than solely the heavens serves as an apt metaphor for the themes discussed in this chapter. Just as Thales needed a reminder to balance his lofty contemplations with practical considerations, investors are encouraged to seek guidance rather than rely solely on their own judgment. The chapter opens with a reflection on the late 1990s, a period marked by investors' enthusiasm for independent trading and research. This era of self-reliance, driven by the advent of online brokerage platforms, was abruptly challenged by the severe bear market of the early 2000s. Many self-directed investors faced substantial losses, prompting a reconsideration of the value of professional financial advice. While it is possible to manage one's own investments, the chapter underscores the benefits of seeking professional help. A good financial advisor can provide not only expertise, but also psychological support during volatile market conditions. This assistance can be crucial in maintaining a steady investment strategy when emotions might otherwise lead to poor decisions. The text identifies several signals indicating when an investor might need professional help. 1. Significant losses. If an investor's portfolio has experienced a loss greater than the market average, it may indicate a need for professional guidance. 2. Budgetary issues. Chronic financial disorganization and inability to save suggest the need for a comprehensive financial plan. 3. Portfolio chaos. Lack of true diversification and the resultant synchronized movements of investments highlight the need for professional asset allocation. 4. Major life changes. Events such as becoming self-employed, planning for children's education, or managing aging parents' finances call for expert advice to navigate complex financial landscapes. The chapter also emphasizes the importance of due diligence in selecting a financial advisor. Investors are advised to thoroughly research potential advisors, ensuring they are trustworthy and have a clean professional record. This involves checking regulatory records and seeking recommendations from trusted individuals. The process of selecting a financial advisor should involve a series of probing questions to assess the advisor's philosophy, expertise, and alignment with the investor's goals. Questions might include inquiries about the advisor's motivation, investment approach, client demographics, and methods for handling poor investment performance. Transparency regarding fees and compensation is crucial to ensure there are no conflicts of interest. Investors should also be prepared for advisors to ask tough questions in return, aimed at understanding the client's financial habits, goals, and emotional responses to market fluctuations. A good advisor will seek to protect clients from their worst impulses, providing systems and plans to guide their financial decisions. In conclusion, the chapter advocates for a balanced approach to investing, where professional advice complements personal judgment. By engaging a qualified advisor, investors can better navigate the complexities of the financial markets, achieving their goals while avoiding the pitfalls of emotional and impulsive decision-making. Chapter 11. Security Analysis for the Lay Investor. General Approach. Security analysis, now a well-established profession, involves the critical examination and evaluation of financial securities. With over 13,000 members in the National Federation of Financial Analysts, the field encompasses various aspects of financial analysis, which extends beyond traditional security analysis to include investment policy and economic analysis. The role of the security analyst. A security analyst investigates the past, present, and future of a security issue. This includes describing the business, summarizing operating results and financial positions, identifying strengths and weaknesses, assessing risks and opportunities, and estimating future earning potential. They compare companies over time and express opinions on the safety of bonds and the attractiveness of stocks. Techniques and standards. Security analysts use a variety of techniques, ranging from elementary to complex. They scrutinize financial statements, adjusting figures when necessary to ensure they reflect true financial health. Analysts develop safety standards to evaluate the soundness of bonds and preferred stocks, primarily based on past earnings, but also considering capital structure, working capital, and asset values. Analysis of bonds and preferred stocks. The most reliable area of security analysis concerns bond safety, determined by the coverage of interest charges by past earnings. For preferred stocks, the criterion is the coverage of combined interest and dividend obligations. Standards are somewhat arbitrary and vary among authorities, but typical measures include earnings coverage, asset values, and stock equity ratios. Assessing safety tests of safety based on historical performance have proven effective in predicting future solvency. This is particularly true for bonds and preferred stocks of companies with sound capitalization. Conversely, excessive debt and inadequate earnings coverage often precede financial distress. Public utilities and industrial bonds. Public utilities, subject to strict regulatory oversight, have shown remarkable financial stability. In contrast, industrial bonds, despite overall growth, exhibit less stability for individual companies. Historically, industrial bonds have been more vulnerable to economic downturns, highlighting the importance of selecting investments in well-established, resilient companies. Valuing common stocks. Valuing common stocks has traditionally been less precise, relying on summaries of past performance and general forecasts. Recently, more emphasis has been placed on valuing growth stocks, requiring detailed earnings projections and sophisticated mathematical techniques. However, these projections are inherently uncertain, making valuations less reliable. Conclusion. Security analysis for the lay investor begins with understanding a company's financial reports, as discussed in The Interpretation of Financial Statements. Key elements include assessing the safety of bonds and the valuation of common stocks. By understanding these principles, non-professional investors can better distinguish between superficial and sound analyses, aiding in more informed investment decisions. Common stock analysis, a professional overview. Common stock analysis aims to determine the intrinsic value of a stock, which is then compared to its current market price to evaluate its investment attractiveness. The cornerstone of this analysis involves forecasting future earnings and applying an appropriate capitalization factor to these earnings. Estimating future earnings. The standard procedure for estimating a company's future earning power begins with analyzing past data on physical volume, prices, and operating margins. Future sales are projected by assuming changes in volume and price levels, anchored in broader economic forecasts like the gross national product, and tailored to industry-specific and company-specific factors. Hash valuation methods. A prominent example of this valuation method is provided by ValueLine, which forecasts future earnings and dividends using historical data. They then have a valuation formula based on historical relationships to estimate the price potentiality or projected market value. Accuracy of forecasts. Historical analysis shows that group forecasts tend to be more reliable than individual company forecasts. This highlights the difficulty in consistently predicting individual company performance, justifying the widespread practice of diversification among investment funds to mitigate risk. Factors in influencing valuation. Although future earnings are crucial, several other factors influence the capitalization rate and consequently the valuation of a stock. 1. General long-term prospects. Analysts assess industry-specific and company-specific future prospects, often reflected in price-earnings (PE) ratios. For example, historical data show that market multipliers based on past performance can sometimes be inaccurate. 2. Management quality. While management quality is often emphasized, its assessment remains subjective and challenging. However, changes in management that lead to significant performance improvements can be a crucial factor. 3. Financial strength and capital structure. Companies with strong financial positions, minimal debt, and substantial cash reserves are generally valued higher than those with heavy debt loads. 4. Dividend record. A long history of uninterrupted dividend payments is a strong indicator of a company's stability and quality. 5. Current dividend rate. Companies typically distribute about 2/3 of their earnings as dividends. Deviations from this norm, especially among growth companies retaining profits for expansion, need careful consideration. Valuation of growth stocks. Growth stocks are often valued using formulas that account for their expected growth rates. A simplified formula for growth stock valuation might be text value equal x current normal earnings times 8.5 plus 2 times text x expected annual growth rate. This formula helps estimate the value based on projected growth over the next 7 to 10 years. Industry analysis. The economic position of an industry significantly impacts stock prices. Analysts study industry trends, technological advancements, and other factors to forecast future profitability. However, industry forecasts often reflect widely known information and may not provide a substantial advantage. A two-part appraisal process. A more structured approach to stock valuation involves two steps. 1. Past performance value, calculating the stock's value based on past performance, assuming that future performance will mirror the past. 2. Future modifications, adjusting the past performance value based on expected future changes. This approach involves both senior and junior analysts, with the senior analysts developing the valuation formula and the junior analysts applying it to individual companies. The senior analyst then adjusts the valuation based on anticipated changes. Practical implications. While the method described may not always yield perfectly accurate valuations, it provides a systematic framework for analysis, contributing to a deeper understanding and better decision-making process in stock investments. The approach is particularly useful for stocks with reasonably predictable futures or significant margins of safety based on past performance. In summary, common stock analysis combines historical data with future projections to derive stock valuations. This process is nuanced, requiring consideration of various qualitative and quantitative factors, and is fundamental for making informed investment decisions. Chapter 11 delves into the intricate process of determining the value of a stock in today's market. Benjamin Graham, the revered financial mind, underscores 5 pivotal elements that should guide this evaluation. These factors encompass the company's long-term prospects, the caliber of its management, its financial robustness and capital structure, its dividend history, and its prevailing dividend rate. As investors navigate the complexities of the modern market landscape, a meticulous analysis of these facets is imperative to ascertain fair value and mitigate the risk of overpayment for a potentially promising yet uncertain future. The chapter commences by emphasizing the paramount importance of comprehending a company's trajectory over time. In this digital age, investors are encouraged to meticulously review a company's annual reports spanning at least half a decade, which are conveniently accessible through the company's website or the EDGAR database. This retrospective examination aims to address 2 fundamental queries. What propels the company's growth, and where do its profits emanate and are projected to originate from? While dissecting the financial statements, investors must remain vigilant for red flags indicative of underlying issues. These cautionary indicators encompass scenarios such as excessive acquisition activity, reliance on external financing through debt or equity, and an over-reliance on a single customer or a handful thereof, each of which can potentially portend future turbulence. Concurrently, investors are advised to discern positive signals that underscore a company's resilience and growth potential. These favorable indicators include the presence of a wide competitive moat, signifying a durable competitive advantage, and a steady, sustainable growth trajectory over an extended period. Moreover, prudent allocation of resources towards research and development activities underscores a company's commitment to innovation and future sustainability. The narrative then shifts towards an examination of managerial competence and integrity, asserting that a company's executives should be held accountable for their actions and commitments. Investors are urged to scrutinize past annual reports to evaluate the alignment between managerial forecasts and subsequent outcomes. Furthermore, executives should demonstrate a steadfast commitment to shareholder interests, eschewing self-serving practices such as exorbitant compensation or opportunistic repricing of stock options. Transparency in communication, adherence to ethical accounting practices, and a steadfast focus on long-term value creation should be prioritized over short-term gains and promotional tactics. Subsequently, the discourse extends to the financial fortitude and capital structure of a company, delineating the fundamental principle that a sound business generates more cash than it consumes. Investors are advised to examine the statement of cash flows to gauge the consistency of cash generation over a 10-year horizon. Additionally, the concept of owner earnings, which adjusts for non-cash accounting entries and reflects the true cash-generating capacity of a business, is introduced as a more accurate metric for assessing profitability. Furthermore, prudent management of capital structure characterized by a judicious balance between debt and equity financing is paramount to ensure long-term solvency and mitigate the risk of financial distress. The chapter concludes with insights into dividend policies and stock repurchasing strategies, advocating for a shareholder-centric approach that prioritizes prudent capital allocation and long-term value creation over short-term market sentiments. In essence, Chapter 11 serves as a comprehensive guide for investors navigating the intricacies of stock valuation in today's dynamic market environment, emphasizing the significance of diligent research, discerning judgment, and unwavering adherence to fundamental investment principles. Chapter 12 delves into the intricacies of evaluating per-share earnings, highlighting the nuanced challenges investors face in deciphering financial reports. The chapter commences with a paradoxical admonition. While urging investors not to overly fixate on single-year earnings, it underscores the importance of scrutinizing short-term figures, particularly per-share earnings, for potential distortions. Using the example of Aluminum Company of America, Alcoa's 1970 earnings report, the chapter elucidates the complexities lurking beneath seemingly straightforward earnings figures. Alcoa's earnings disclosure reveals multiple permutations of earnings metrics, including primary earnings, net income after special charges, and fully diluted earnings, complicating the determination of true earnings. A significant aspect of Alcoa's earnings scrutiny involves accounting for dilution factors, such as the conversion of bonds into common stock, which can deflate apparent earnings. Moreover, the chapter illuminates the impact of special charges, dissecting Alcoa's decision to preemptively account for future losses, a strategy that could inflate future earnings post-tax credit. Further complicating the evaluation are questions surrounding the classification of certain expenses as special charges and their treatment in financial reporting. The narrative unveils the practice of companies strategically timing these charges to minimize their immediate impact on earnings, thereby enhancing future earnings prospects. Beyond Alcoa, the chapter scrutinizes broader accounting variables, including depreciation methods, inventory valuation techniques, and treatment of research and development costs. It underscores the need for investors to discern the materiality of these variables amid Wall Street's propensity to magnify even minor accounting discrepancies. The discussion extends to the historical practice of averaging earnings over extended periods to mitigate cyclical fluctuations, offering a holistic view of a company's earning power. Additionally, it advocates for calculating past growth rates to gauge a company's trajectory accurately. In evaluating Alcoa's historical performance relative to market valuations, the chapter acknowledges the dissonance between past growth and market perception. Despite Alcoa's robust earnings history, market sentiment discounted its future prospects, underscoring the challenge of reconciling historical performance with forward-looking expectations. Ultimately, the chapter underscores the inherent uncertainty in stock valuation, urging investors to exercise caution and diligence in interpreting earnings reports and navigating the complexities of financial analysis. Chapter 12 of the text delves into the intricate world of corporate accounting practices, shedding light on the deceptive maneuvers companies employ to present a rosier financial picture than reality warrants. Drawing from a plethora of real-world examples, the chapter dissects various dubious tactics, ranging from pro forma earnings adjustments to aggressive revenue recognition and creative capitalization. One of the central themes revolves around the misuse of pro forma earnings, originally intended to provide insights into long-term earnings growth, but increasingly manipulated to obfuscate poor performance. Through selective omissions and adjustments, companies portrayed a distorted view of their financial health, masking underlying weaknesses and misleading investors. Moreover, the chapter scrutinizes the perilous terrain of revenue recognition, exemplified by Quest Communications International Inc.'s dubious accounting treatment of telephone directory revenues. By prematurely recognizing profits, companies artificially inflate their bottom line, camouflaging fundamental issues that may culminate in substantial losses down the line. Global Crossing Ltd's case serves as a cautionary tale on the abuse of capital expenditures where legitimate expenses are transformed into capital assets to inflate reported profits. This practice, though technically permissible under accounting standards, can mislead investors by distorting the true financial position of a company. Micron Technology Inc.'s recurrent inventory write-downs underscore the importance of vigilance against purportedly non-recurring costs that may persistently erode earnings. Such write-downs, initially perceived as isolated incidents, can morph into chronic liabilities, undermining investor confidence and exposing the fragility of a company's operations. Furthermore, the chapter elucidates the intricacies of pension accounting, exemplified by SBC Communications Inc.'s questionable practice of inflating income through optimistic assumptions about future returns on pension assets. By artificially boosting current earnings with pension surplus, companies risk masking underlying vulnerabilities and misleading stakeholders about their true financial standing. In conclusion, Chapter 12 provides a comprehensive exposé of the manipulative practices rampant in corporate accounting, urging investors to exercise caution and thorough due diligence when interpreting financial statements. By peeling back the layers of deceptive accounting practices and interrogating the footnotes, investors can mitigate the risk of falling victim to misleading financial reporting and make informed investment decisions. Chapter 13 of this analysis presents a comparative study of 4 notable companies listed on the New York Stock Exchange. These companies, Eltra Corp., Emerson Electric Co., Emery Air Freight, and Emhart Corp., are selected to exemplify various aspects of security analysis. The chapter offers a detailed examination of their market performance, financial metrics, and overall investment appeal. At the outset, the chapter highlights the significant disparity in price-to-earnings ratios among the 4 companies, indicating a wide variance in market valuations. While Eltra and Emhart are relatively modestly priced, Emerson and Emery command significantly higher multiples, reflecting the market's anticipation of superior growth prospects, particularly notable in the case of Emery. The analysis proceeds to evaluate the companies across several key performance indicators. 1. Profitability. Each company's earnings vis-à-vis its book value and profit margins on sales are scrutinized. Emerson and Emery emerge with notably higher profitability metrics, suggesting robust operational efficiency and returns on investment. 2. Stability. The chapter assesses the stability of earnings by examining the maximum decline in per-share earnings over the past decade. Notably, Emerson and Emery exhibit resilience, with minimal earnings contractions even during adverse market conditions. 3. Growth. The growth trajectory of each company is evaluated, with particular emphasis on recent performance. While all companies demonstrate growth, the high multiplier companies, Emerson and Emery, stand out for their remarkable expansion, especially during challenging economic periods. 4. Financial position. The financial health of the companies, including their liquidity and leverage ratios, is analyzed. While all companies maintain sound financial positions, Emery stands out with a lower liquidity ratio, reflective of its unique industry dynamics. 5. Dividends. The chapter underscores the importance of dividend continuity as a measure of financial stability and investor confidence. Emhart garners praise for its uninterrupted dividend payments over more than a century, reflecting a steadfast commitment to shareholder returns. 6. Price history. Historical price movements are examined to provide insights into market sentiment and investment opportunities. Despite fluctuations, all companies have experienced significant appreciation over time, albeit with variations in magnitude. The chapter concludes with general observations and investment recommendations for each company based on their respective strengths and risks. Notably, Eltra and Emhart are deemed as offering reasonable value and investment protection, whereas Emerson and Emery, despite their market appeal and growth potential, carry higher risk due to their premium valuations. Ultimately, the chapter emphasizes the importance of aligning investment decisions with individual risk preferences and long-term objectives, highlighting the nuanced interplay between value and glamour in stock selection. Chapter 13 of the provided text offers a comprehensive analysis and retrospective of 4 distinct companies within the context of e-business during the late 1990s, examining their performances, valuations, and subsequent trajectories. The chapter begins by illustrating the imperative mantra of vigilance in the Air Force, using the metaphor of checking six, emphasizing the criticality of identifying vulnerabilities even when one feels secure, a principle underscored throughout the subsequent financial evaluations. Transitioning to the e-business sector, the text juxtaposes four companies: Emerson Electric Co., EMC Corp., Expeditors International of Washington, Inc., and Exodus Communications, Inc., presenting a snapshot of their financial standings as of December 31, 1999, amidst the fervor of the late 1990s stock market. Emerson Electric, despite its subdued valuation during the internet boom, exhibited resilience and stability in its core operations, characterized by consistent revenue growth, earnings, and dividend increases. While its stock may have appeared lackluster, the company's fundamental strength was evident. Conversely, EMC Corp., emblematic of the exuberance of the era, experienced astronomical stock price appreciation, propelled by optimistic projections, fueled by the Internet's burgeoning potential. However, beneath the veneer of growth lay signs of concern, such as diminishing profit margins and questionable organic growth rates. Expeditors International, although relatively obscure in comparison to its peers, demonstrated remarkable operational performance and financial robustness, substantiated by consistent revenue and earnings growth, with minimal debt and expanding shareholder equity. Lastly, Exodus Communications epitomized the speculative fervor of the dot-com bubble, with its meteoric stock price ascent divorced from underlying financial realities. Despite soaring revenues, Exodus hemorrhaged cash, accumulated substantial debt, and eventually succumbed to bankruptcy, leaving investors disillusioned. The chapter concludes by juxtaposing the subsequent performances of these companies post-1999, revealing the contrasting outcomes. Emerson Electric and Expeditors International maintained resilience, while EMC and Exodus exemplified the perils of speculative excess and overvaluation, serving as cautionary tales amid the tumultuous e-business landscape of the late 1990s. Chapter 14 delves into the practical applications of security analysis for investors, particularly focusing on stock selection for the defensive investor archetype. It begins by reiterating the investment policies recommended for two categories of investors: defensive and enterprising. The defensive investor, as outlined previously, is advised to prioritize high-grade bonds and a diversified portfolio of leading common stocks, ensuring that stock purchases are not overly priced according to established standards. Two primary approaches to building a diversified stock portfolio are presented: the DJIA-type portfolio and the quantitatively tested portfolio. The former involves acquiring a cross-section sample of leading issues, such as those in the Dow Jones Industrial Average. The latter approach employs a set of standards for each purchase, ensuring a minimum level of quality and quantity in company performance and financial metrics. 7 criteria are outlined for the selection of specific common stocks, including adequate enterprise size, strong financial condition, earnings stability, dividend record, earnings growth, moderate price-earnings ratio, and price-to-assets ratio. These criteria are tailored to suit the needs and temperament of defensive investors, aimed at excluding companies deemed too small, financially weak, or lacking in consistent performance and dividend history. The chapter provides detailed analysis and application of these criteria to various types of stocks, including industrial, public utility, financial, and railroad issues. Additionally, the chapter discusses the contrasting approaches of prediction and protection in security analysis. While the predictive approach focuses on anticipating future company performance and growth, the protective approach emphasizes ensuring a substantial margin of present value above market price, without overly relying on future prospects. The chapter advocates for the quantitative or statistical approach, which prioritizes measurable relationships between price and fundamental financial metrics. Overall, the chapter emphasizes the importance of a disciplined, quantitative approach to stock selection for defensive investors, prioritizing value and diversification over speculative predictions of future performance. It concludes by advising investors to focus on diversification within established selection criteria, while considering technological developments and maintaining a balanced approach to investment decisions. Chapter 14 of the discussed text navigates the nuanced terrain of stock selection through the lens of the renowned investment philosophy of Benjamin Graham, as elaborated upon by Jason Zweig. Centered on the principle of defensive investing, the chapter elucidates the practical strategies and criteria essential for prudent stock selection, echoing timeless wisdom juxtaposed with contemporary market dynamics. The chapter initiates with a pertinent reflection from Sir Francis Bacon, highlighting the delicate balance between assured gains and speculative ventures, a theme emblematic of Graham's philosophy. It sets the stage for the exploration of Graham's seminal principles in stock selection, elucidating a pragmatic approach that prioritizes consistency and prudence over speculative endeavors. Zweig underscores the accessibility and efficacy of index funds, particularly in today's market landscape, as the cornerstone of a defensive investor's portfolio. By advocating for the simplicity and reliability of index funds, the narrative emphasizes the merit of broad diversification as a shield against market volatility and individual stock risk. However, it also acknowledges the allure of stock picking for some investors, albeit with cautionary advice to maintain a predominantly index-based portfolio, supplemented with a modest allocation for individual stock selection. The discourse further delves into the rationale behind diversification, debunking the myth of forsaking potential high returns for the safety of diversification. Through historical anecdotes and statistical analysis, it underscores the indispensable role of diversification in mitigating risk and maximizing the probability of capturing substantial market gains, a principle foundational to Graham's investment philosophy. Against this backdrop, the chapter methodically revisits Graham's criteria for stock selection, adapting them to contemporary market realities. From considerations of company size and financial strength to earnings stability and dividend records, each criterion is meticulously examined in light of modern market dynamics, underscoring their enduring relevance in identifying fundamentally sound investments. Moreover, the narrative elucidates the importance of conducting due diligence, advocating for thorough research and scrutiny of financial reports to inform investment decisions. It underscores the accessibility of resources such as the Edgar database for comprehensive analysis of company fundamentals, alongside leveraging online platforms for insights into institutional ownership and market sentiment. In essence, Chapter 14 encapsulates the essence of defensive investing, marrying timeless principles with contemporary insights to equip investors with the knowledge and tools necessary for prudent stock selection in an ever-evolving market landscape. Through a synthesis of historical wisdom and pragmatic advice, it offers a roadmap for investors seeking to navigate the complexities of stock selection with diligence and discernment. Chapter 15. Stock Selection for the Enterprising Investor. Overview. In the previous chapter, we explored common stock selection for the defensive investor, focusing on broad groups of eligible securities and emphasizing exclusions to avoid recognizably poor quality issues and overly high-priced, high-quality issues that pose speculative risks. In this chapter, we address the enterprising investor and the strategies for making individual stock selections that are likely to outperform the general market average. Prospects of successful stock selection. The possibility of consistently selecting stocks that outperform the market is uncertain and challenging. While average results can be achieved by mimicking broad market indices like the DJIA, obtaining superior results requires skill and expertise. Despite the availability of advanced financial and security analysts, the performance of many investment funds has historically lagged behind the market averages. Comprehensive studies have shown that random portfolios often outperform mutual funds within the same risk class, suggesting that achieving superior returns through individual stock selection is difficult. Explanations for difficulty in stock selection. Two main explanations are offered for the difficulty in achieving superior stock selection. 1. Market efficiency. The stock market may reflect all known information about a company's past and current performance and reasonable future expectations in the current prices. As a result, stock price movements are often driven by unforeseen developments, making them unpredictable. The vast number of security analysts studying the market ensures that stock prices reflect the consensus of informed opinions, leaving little room for superior predictions. 2. Flawed approach of analysts. Many security analysts focus on industries and companies with the best growth prospects and management, often ignoring the price paid for such stocks. This approach assumes continuous rapid growth, which is rare in reality. Most companies experience cycles of ups and downs, and their long-term performance may not justify high initial valuations. Therefore, analysts' emphasis on growth industries and companies at any price might lead to poor long-term investment outcomes. Strategies for the enterprising investor. The enterprising investor must follow unconventional methods to profit from market undervaluations. Such methods include arbitrages, buying a security and simultaneously selling another security into which it will be converted under a reorganization or merger plan. Liquidations, purchasing shares that will receive cash payments during company liquidation. Related hedges, buying convertible bonds or preferred shares and selling the common stock they can be converted into to profit from price discrepancies. Net current asset bargain issues, acquiring stocks priced below their net current asset values, ensuring a margin of safety. These methods, while complex and requiring substantial expertise, have historically yielded satisfactory results for enterprising investors. Secondary companies and stock guide analysis. Another approach for enterprising investors involves selecting secondary companies that are financially sound but not popular with the public. A practical method is using resources like the Standard & Poor's Stock Guide to identify undervalued stocks based on criteria such as low price-to-earnings ratio, strong financial condition, current assets at least 1.5 times current liabilities, low debt, earnings stability, no deficits in the last 5 years, dividend record, consistent dividends, earnings growth, recent earnings higher than in previous years, price below net tangible asset value. By applying these criteria, an investor can create a diversified portfolio of stocks that offer good potential for satisfactory investment returns. Summary and conclusion. Achieving superior results through individual stock selection is challenging due to market efficiency and common analytical flaws. However, by employing unconventional strategies and rigorous selection criteria, enterprising investors can identify undervalued opportunities. A focus on financially sound secondary companies and thorough analysis using tools like the Standard & Poor's Stock Guide can aid in building a robust portfolio. Nonetheless, the enterprising investor must possess the temperament and expertise to execute these strategies effectively. Market speculations and special situations, an analysis. In times of economic exuberance, the stock market often witnesses the emergence of numerous low-quality stock offerings. These stocks, despite their lack of substantial backing in assets or earnings, quickly attract enthusiastic buyers, pushing their prices to heights that make even industry giants like IBM, Xerox, and Polaroid appear undervalued in comparison. This phenomenon, though clearly irrational, is largely tolerated by Wall Street without any significant intervention to curb the speculative frenzy before the inevitable market correction occurs. Regulatory bodies like the SEC can only mandate the disclosure of information, which often goes ignored by the speculative public, or impose mild punitive measures after legal violations are evident. The subsequent collapse of these overvalued enterprises is usually accepted philosophically as an unavoidable aspect of market dynamics, with market participants vowing to avoid such speculative excesses until the next cycle of exuberance ensues. Despite the speculative nature of such stocks, there exists a class of investments known as bargain issues that can yield substantial returns without significant risk. These investments, if chosen with care and patience, can provide considerable profits. For instance, the Burton-Dixie Corp. Was recommended when its stock was trading at $20, despite a net current asset value of $30 and a book value of approximately $50. Although a profit was not immediate, patient investors who held the stock from March 1964 saw an offer of $53.75 per share in August 1967. Representing a 165% profit over 3.5 years, or a non-compounded annual return of 47%. Similar opportunities, such as the current recommendation of National Presto Industries, demonstrate the potential of these bargain issues to deliver substantial returns. Special situations or workouts. Special situations or workouts represent another area of investment interest, theoretically suitable for an enterprising investor. These involve strategic investments in corporate actions such as mergers, acquisitions, or liquidations. Here are 3 examples from early 1971. 1. Kaiser-Roth acquisition by Borden's. In January 1971, Borden Inc. proposed to acquire Kaiser-Roth by exchanging 1/3 shares of Borden stock for each share of Kaiser-Roth. At the announcement, Borden stock was at $26 and Kaiser-Roth at $28. An investor purchasing 300 shares of Kaiser-Roth and short-selling 400 shares of Borden stood to gain a 24% profit on their investment if the deal concluded within 6 months, equating to an annualized return of 40%. 2. National Biscuit Co. and Aurora Plastics Co. In November 1970, National Biscuit Co. offered to buy Aurora Plastics for $11 per share when the stock was trading at $8.5, closing the year at $9. This presented an initial gross profit potential of about 25%, subject to the deal's completion and time considerations. 3. Universal Marion Co. dissolution. Universal Marion Co., having ceased operations, proposed liquidation with a book value of $28 per share. Trading at $21.5 at year-end 1970, this suggested a potential gross profit exceeding 30% if book value was realized during liquidation. These situations, if approached with careful analysis and diversified to spread risk, could yield annual profits exceeding 20%, making them highly attractive. However, the increasing number of unconsummated mergers poses a risk, underscoring the need for professional judgment to select the most promising opportunities and mitigate potential losses. Detailed case outcomes. 1. Kaiser-Roth. The directors of Kaiser-Roth rejected Borden's offer, resulting in an overall loss of approximately 12% for those who had engaged in the arbitrage opportunity. 2. Aurora Plastics. After renegotiation, National Biscuit paid $10.5 per share, resulting in an annual return of about 25% for investors who participated in the deal. 3. Universal Marion. The company distributed an initial cash and stock payout worth $7 per share, reducing the investment base to $14.5. Subsequent market fluctuations cast doubt on the ultimate liquidation value, indicating the complexity and risk involved. These examples highlight that while workout opportunities can be lucrative, they are best left to experienced professionals who can navigate the complexities and uncertainties inherent in such investments. The fluctuating outcomes of these cases illustrate the necessity of thorough analysis and strategic selection in achieving favorable returns. Commentary on Chapter 15, Expert Insights into Stock Picking, the Essence of Independence in a Crowd. Ralph Waldo Emerson's quote underscores the rarity and value of maintaining individual thought in the face of collective opinion. This concept, applied to investing, emphasizes the importance of adhering to a disciplined, independent strategy rather than succumbing to market trends. The importance of practice. Max Heine's adage, "There are many roads to Jerusalem," highlights the diversity of successful investment strategies. This chapter delves into various methodologies used by prominent money managers. However, it cautions that most individual investors should avoid stock picking, as even professionals often fail at it. Instead, it advises novice investors to practice without real money, using tools like portfolio trackers to develop discipline and refine their techniques. This practice phase is crucial for learning from mistakes without financial loss and for evaluating one's aptitude against a simple benchmark like the S&P 500 index fund. Techniques for identifying rewarding stocks. For those who wish to proceed with stock picking, the chapter recommends starting with tools such as stock screeners available on financial websites. It advises looking for companies that have become unfashionable, as indicated by their prices hitting new 52-week lows. This contrarian approach is favored by many successful investors who see potential where others see decline. Evaluating companies with ROIC. Return on invested capital, ROIC, is a key metric for assessing a company's efficiency in generating profits from its investments. High ROIC indicates a company is using its capital effectively, which can be a sign of strong management and a sound business model. The chapter provides a detailed formula for calculating ROIC, emphasizing its value over more commonly used metrics like earnings per share, EPS, which can be distorted by various accounting practices. Dissecting company value. Analyzing a company's segments separately can reveal hidden value, particularly if the market undervalues the sum of its parts. This detailed analysis involves comparing the company's divisions to similar businesses that have been recently acquired, providing a realistic estimate of their worth. Investors like Longleaf Partners O. Mason Hawkins seek companies trading at a significant discount to their appraised value, ensuring a margin of safety. Management quality. The quality of a company's management is a crucial factor in its success. Good managers are candid about challenges, have clear plans for capital allocation, and align their interests with shareholders by owning substantial stock. Conversely, frequent extraordinary charges or a focus on stock price over business fundamentals are red flags. Consistency and thoughtfulness. Successful investors are marked by their consistency and thoughtfulness. They adhere to their investment principles even when they are out of favor and focus more on their strategy than on market movements. This disciplined approach, coupled with a deep understanding of the businesses they invest in, sets them apart. Learning from masters. The chapter concludes with an appreciation of Warren Buffett, who has famously built his fortune by adhering to and innovating on Benjamin Graham's principles. Buffett's preference for strong, easily understandable businesses with sustainable earnings growth and his public transparency about his investment philosophy offer invaluable lessons for all investors. Conclusion. Chapter 15 provides a comprehensive guide to stock picking, blending practical advice with insights from successful investors. It emphasizes the importance of practice, the value of independent thinking, and the need for a disciplined, thoughtful approach to investing. By learning from the techniques and philosophies of investment masters, individual investors can develop their own strategies and potentially achieve better investment outcomes. Chapter 16. Convertible Issues and Warrants. In recent years, convertible bonds and preferred stocks have gained significant importance in senior financing. Alongside, stock option warrants, which grant long-term rights to buy common shares at set prices, have proliferated. Currently, over half of the preferred issues in Standard & Poor's Stock Guide include conversion privileges, reflecting similar trends in corporate bond financing during 1968 to 1970. The American Stock Exchange deals with at least 60 series of stock option warrants. Notably, in 1970, the New York Stock Exchange listed long-term warrants for the first time, with rights to purchase 31,400 American TEL and TEL shares at $52 each, marking a significant milestone. Convertible issues. Investment opportunities and risks. Convertible issues generally hold more significance than warrants and are examined first. From an investor's perspective, these issues offer two primary considerations: their attractiveness and risk as investments, and their impact on the value of related common stock. Convertible bonds and preferred stocks are seen as beneficial to both investors and issuing corporations. They provide investors with bond or preferred stock protection and the chance to benefit from any substantial rise in common stock value. Issuers can raise capital at moderate costs and potentially eliminate senior obligations through conversion to common stock if prosperity allows. However, this seemingly advantageous arrangement has trade-offs. Investors usually sacrifice some yield or quality for the conversion privilege, while companies give up part of the common shareholders' claim to future enhancement. Convertible issues are neither inherently attractive nor unattractive. Their value depends on the specific circumstances of each issue. Market timing and convertible issues. Historically, convertibles floated during the latter part of bull markets tend to yield poor results. This is due to inevitable stock market declines that make conversion privileges less attractive and raise concerns about the underlying issue's safety. The performance of convertibles from 1967 to 1970 supports this, showing greater average price declines compared to common stocks. This suggests that convertibles often possess lower senior issue quality and are linked to common stocks that underperform the general market outside speculative upsurges. Investor challenges and convertibles. Investors in convertibles face a dilemma: when to sell or convert, especially when market conditions fluctuate. The complexities and potential for significant losses highlight the practical challenges. For instance, buying a 6% bond convertible into stock can result in mental and financial strain due to market volatility and speculative decisions. The recommendation often is never convert a convertible bond to maintain the balance of prior claims and profit potential. Evaluating convertible issues. Overall, a cautious approach towards new convertible issues is advised. While they occasionally offer exceptional opportunities, these are rare. Typically, a strongly secured convertible, exchangeable for an attractive common stock at a slightly higher market price, is ideal. Most favorable opportunities are found in older issues rather than new flotations. Impact on common stock and mergers. Convertible issues can affect the status of common stock, particularly in mergers and acquisitions. Although convertibles can temporarily boost reported earnings per share, they often result in actual dilution of current and future earnings due to new conversion rights. This is particularly evident in conglomerates, which frequently use convertibles to manipulate financial appearances. Convertible preferred stocks versus common stocks. Convertible preferred stocks often present more attractive investment opportunities than related common stocks. For example, the Studebaker Worthington Corp. Case in 1970 illustrated the benefits of switching from common to convertible preferred stocks, highlighting the senior position and higher dividend yields offered by preferred stocks. Stock option warrants. Stock option warrants are viewed critically, often described as misleading and potentially disastrous. They create significant market value without substantial backing and can dilute the value of common stocks. The creation and sale of warrants should be limited, as they offer no substantial advantage to companies and complicate capital raising efforts. Practical implications and historical examples. Historically, warrants have shown volatile price histories, sometimes offering spectacular gains, but these are often followed by sharp declines. The strategic use of warrants in bond issues can sometimes be justified, but excessive use of warrants is discouraged due to their propensity to create unfounded market values. Conclusion. Overall, convertible issues and warrants require careful consideration and scrutiny. While they can occasionally offer attractive opportunities, they often come with significant risks and potential pitfalls that investors must navigate carefully. Commentary on Chapter 16, The Zeal of the Convert. In Chapter 16, the complexities and dual nature of convertible bonds are explored, revealing how these securities straddle the line between bonds and stocks. The chapter begins with a biblical epigraph from I Corinthians, highlighting the theme of transformation and potential, akin to the life cycle of a convertible bond. Convertible bonds explained. Convertible bonds, despite their name, function more like stocks due to their inherent options. Investors holding convertibles can choose to retain the bond for interest payments or convert it into common stock at a predetermined ratio. This dual nature results in convertibles offering lower interest rates compared to traditional bonds, but potentially higher returns if the associated stock performs well. Historical data from 1957 to 2002 underscores this duality, showing an average annual return of 8.3% for convertibles, close to that of stocks, but with reduced volatility and losses. Investment characteristics and market dynamics. The behavior of convertibles is closely tied to the stock market, with an 83% correlation to the S&P 500 compared to just 30% with Treasury bonds. This makes them attractive to conservative investors seeking equity-like returns without directly engaging in the stock market. Barry Nelson of Advent Capital Management highlights the growth and evolution of the convertible bond market, noting improvements such as shorter terms, higher credit ratings, and call protection, which have collectively reduced their risk. Practical considerations for investors. Trading convertibles can be costly and diversification challenging without significant capital. However, investors can access this market through low-cost convertible bond funds offered by Fidelity and Vanguard, or through closed-end funds that occasionally trade at discounts to their net asset value. Complex varieties and covered calls. The chapter also delves into more complex and esoteric convertible securities with acronymic nicknames like Lions, Elks, and Yields, which, despite their allure, often impose limits on potential gains while offering protection against losses. The narrative suggests that these complicated instruments are generally more trouble than they are worth and advocates for diversification across cash, bonds, and stocks as a more reliable strategy. Furthermore, the chapter revisits the concept of writing covered call options, a strategy that gained renewed interest during the bear market of 2003. While this approach can provide income through call premiums, it also limits potential gains if the underlying stock's price surges, often benefiting brokers more than investors. The inherent lesson is that protecting against downside risk by capping upside potential is seldom advantageous for individual investors. Conclusion. Chapter 16 offers a nuanced perspective on convertible bonds, highlighting their hybrid nature and the intricate balance of risk and reward they present. The chapter advises intelligent diversification over the allure of seemingly safer but often limiting financial instruments, reinforcing the broader principles of prudent investing. Chapter 17. 4 extremely instructive case histories. In this chapter, we delve into 4 distinct and illustrative case histories that epitomize various extremes observed on Wall Street in recent years. These cases provide critical lessons and stern warnings for all who are involved with stocks and bonds, whether they are ordinary investors, speculators, professional analysts, fund managers, trust administrators, or even bankers. The companies examined and the extremes they represent are 1. Penn Central Railroad Co. Extreme, ignoring clear financial warning signs. Details. Penn Central's bankruptcy in 1970 shocked the financial world. The company failed to meet basic standards of financial health, leading to drastic price drops in its securities and an eventual collapse. By applying fundamental rules of security analysis, the inherent weaknesses should have been evident long before the bankruptcy. 2. Ling Temco Vought Inc. Extreme, rapid and unsound expansion leading to collapse. Details. This company exemplifies reckless empire building, supported by indiscriminate bank lending. Rapid expansion and soaring debt led to severe financial problems, massive losses, and a significant drop in stock prices. The story underscores the dangers of aggressive growth strategies without sustainable financial foundations. 3. NVF Corp. Extreme, a small company acquiring a much larger one, resulting in heavy debt and creative accounting. Details. NVF's acquisition of Sharon Steel Corp., a company 7 times its size, led to massive debt and complex accounting maneuvers. The merger severely compromised NVF's financial position, demonstrating the risks associated with disproportionate acquisitions and the use of intricate financial strategies to mask underlying problems. 4. AAA Enterprises. Extreme. Public stock financing of a small company based on hype rather than substance. Details. AAA Enterprises' meteoric rise, fueled by the franchising buzzword, ended in bankruptcy within 2 years. Despite initial high valuations and stock price surges, the company's flimsy financial base and overambitious expansion led to its downfall. The case highlights the perils of speculative investments and the responsibilities of those promoting such stocks. Detailed analysis of Penn Central. Penn Central's financial collapse. Overview. Once the largest railroad in terms of assets and revenues, Penn Central's bankruptcy in 1970 was a significant financial disaster. Despite clear signs of financial distress, investors and analysts failed to heed basic warnings. Financial indicators. Penn Central's interest coverage ratios were well below conservative standards. The company had not paid significant income taxes for over a decade, casting doubt on its reported earnings. Investment alternatives. Bondholders could have exchanged Penn Central bonds for more secure public utility bonds without sacrificing price or income. That's significantly mitigating their losses. Analyst oversight. Fundamental weaknesses, such as the poor transportation ratio and dubious earnings reports, should have been red flags for any competent analyst. Temco-Vought's expansion and collapse. Expansion. From humble beginnings, the company expanded rapidly, amassing huge debts. In just a few years, sales grew 20-fold, but the expansion was unsustainable. Financial mismanagement. The company's debt reached alarming levels, and despite a brief period of record earnings, the financial foundation was shaky. Eventually, significant losses and financial instability led to a dramatic decline in stock prices. NVF's takeover of Sharon Steel. Merger dynamics. NVF's acquisition of a much larger Sharon Steel led to a precarious financial situation, with the new company shouldering enormous debt. The acquisition strategy involved complex accounting practices aimed at minimizing tax liabilities. Financial impact. The merger drastically reduced NVF's tangible equity and introduced significant financial risks, reflected in the depressed market value of its bonds. AAA Enterprises' flawed stock financing. Initial success. The company's initial public offering was highly successful, driven by the franchising trend. However, the business's actual financial performance did not justify the high stock valuations. Subsequent failure. Rapid expansion into new business areas and unrealistic financial projections led to substantial losses. Within a short period, the company's financial health deteriorated, leading to bankruptcy. Conclusion. The chapter concludes with a reflection on the lessons from these case histories. It emphasizes the importance of basic security analysis, sound financial management, and the dangers of speculative investments. Additionally, it questions the role of financial institutions and regulatory bodies in preventing such financial debacles, suggesting that higher ethical standards and possibly stronger regulatory measures could help protect investors from similar pitfalls in the future. Chapter 17 offers a compelling commentary on the pitfalls of investment extremes, drawing from historical anecdotes and contemporary examples to underscore timeless lessons. Gardner's narrative of Woden's quest for order amidst chaos serves as a thematic prelude, setting the stage for the subsequent exploration of 4 distinct investment scenarios. Graham's conceptualization of extremes provides a framework to dissect contemporary market phenomena. Through Graham's lens, we encounter narratives of corporate giants, such as Lucent Technologies, Tyco International Limited, America Online Inc., and eToys Inc. Each exemplifies an extreme, whether it be an overpriced conglomerate, a merger of disproportionate magnitude, or an initial public offering, IPO, with dubious fundamentals. Lucent Technologies emerges as a cautionary tale of inflated valuations and misguided acquisitions. The folly of its Chromatus Networks purchase, laden with goodwill and devoid of tangible assets, underscores the dangers of speculative exuberance. Similarly, Tyco International's voracious acquisition spree belies underlying financial intricacies, epitomized by recurring charges and opaque accounting practices. The case of America Online's merger with Time Warner reveals the fallacy of perceived synergies, as lofty promises give way to staggering losses and regulatory scrutiny. Finally, eToys Inc.'s meteoric rise and subsequent bankruptcy epitomize the perils of speculative fervor and market irrationality. Through meticulous analysis, the chapter dismantles the facade of market euphoria, revealing the inherent risks of investment extremes. From Lucent's precipitous decline to eToys' ignominious demise, each case serves as a cautionary testament to the enduring wisdom of prudent investment principles. In a landscape fraught with uncertainty, Graham's steadfast principles provide a beacon of rationality amidst the tempestuous seas of speculation. Chapter 18 delves into a comparative analysis of 8 pairs of companies listed on the stock exchange. This unique approach aims to illuminate the diverse characteristics, financial structures, policies, performances, and fluctuations prevalent in corporate enterprises and investment attitudes in recent years. Each comparison underscores distinctive aspects that hold significance. The chapter commences with a juxtaposition of Real Estate Investment Trust, REI, and Realty Equities Corp. of New York, REC. Despite their proximity in name and listing, they epitomize starkly different trajectories in corporate operations. REI embodies stability and prudence, dating back nearly a century with consistent dividends since 1889. In contrast, RIC epitomizes rapid expansion, ballooning its assets and debts exponentially over 8 years into a conglomerate of ventures spanning various industries. The contrasting financial structures and practices of the two companies, delineated through intricate details of stock valuations, debt obligations, and ventures, underscore the polarized nature of corporate approaches. The narrative then shifts to an analysis of Air Products and Chemicals versus Air Reduction Co., which share not only a similar line of business, but also similarities in name. Despite their apparent resemblance, Air Reduction outperforms Air Products in profitability and growth, yet trades at a lower relative price. The discussion highlights the nuanced interplay between quality and quantity in investment decisions, wherein Wall Street tends to favor quality despite higher prices, potentially influencing future outcomes. The comparison extends to American Home Products Co. and American Hospital Supply Co., both representing segments of the burgeoning health industry. While both companies exhibit robust growth and financial stability, they differ in profitability and valuation. The cautionary note on the inflated goodwill valuation of both companies underscores the necessity for investors to critically evaluate promises versus tangible performance. In sum, Chapter 18 offers a detailed exploration of diverse corporate trajectories, financial structures, and investment attitudes, emphasizing the complexities inherent in investment decision-making amid fluctuating market conditions. Pair 4 presents an intriguing dichotomy between H&R Block, Inc. and Bluebell, Inc., underscoring their distinctive trajectories within the market. Bluebell, having weathered the competitive storms in its industry, emerged as a significant player, boasting impressive growth since 1965 despite earnings fluctuations tied to industry conditions. Its roots trace back to 1916, with a continuous dividend record since 1923. However, the stock market exhibited tepid enthusiasm for Bluebell, valuing it at a modest price-earnings ratio of 11 by the close of 1969, contrasting with H&R Block's meteoric rise. In contrast, H&R Block's ascent was meteoric, its earnings skyrocketing from $83,000 in 1961 to a staggering $6.3 million by 1969. The market's response was one of exuberance, evidenced by its stock price exceeding 100 times its last reported earnings, far surpassing industry norms. Despite concerns about competition in the income tax service sector, H&R Block's momentum was undeniable, with analysts acknowledging its promising growth prospects. The post-1970 market upheaval saw both companies experiencing significant price fluctuations, with Bluebell proving to be a more resilient investment than initially perceived. However, H&R Block's ability to rebound from apparent overvaluation showcased the caution necessary in discounting solid performers prematurely. Pair 5 juxtaposes International Flavors and Fragrances, IFF, and International Harvester Co., highlighting their starkly contrasting performances. While International Harvester enjoys widespread recognition as a Dow Jones Industrial Average constituent, International Flavors and Fragrances operates under the radar. Nonetheless, IFF's market value surpassed Harvester's, despite the latter boasting significantly higher stock capital and sales. This disparity stemmed from IFF's remarkable profitability and growth, with earnings far outstripping Harvester's modest gains. IFF's profitability, with a profit margin of 14.3% compared to Harvester's meager 2.6%, underscored its market appeal. The market's response was reflected in IFF's lofty price-earnings ratio of 55, significantly higher than Harvester's 10.7. This valuation discrepancy highlighted Wall Street's penchant for rewarding robust performance, with IFF emerging as a favored investment despite its comparatively smaller scale. Pair 6 features McGraw-Edison and McGraw-Hill, Inc., two corporate giants occupying divergent sectors. Despite similar stock prices, McGraw-Hill's larger capitalization translated into a valuation double that of McGraw-Edison. This discrepancy stemmed from Wall Street's enthusiastic bias towards book publishing companies, evident in McGraw-Hill's inflated price-earnings ratio. McGraw-Hill's declining profits in 1968 reflected market overvaluation, with its stock price failing to align with diminishing earnings. In contrast, McGraw-Edison appeared reasonably priced, underscoring the pitfalls of speculative enthusiasm in inflating stock values. Pair 7 contrasts National General Corp. And National Presto Industries, illustrating the vast differences between conglomerates. While General pursued a sprawling conglomerate model, Presto's diversification remained relatively modest. Despite General's larger capitalization, its performance paled in comparison to Presto's, with the latter boasting superior profitability and growth. General's convoluted capital structure obscured its true market value, with warrants complicating the assessment. Presto's straightforward capitalization and robust performance positioned it as a sound investment, contrasting sharply with General's speculative allure. Pair 8 juxtaposes Whiting Corp. And Wilcox & Gibbs, revealing the irrationality inherent in market valuations. Despite Whiting's superior financial performance, Wilcox & Gibbs commanded a significantly higher market valuation, a testament to Wall Street's capricious nature. Whiting's consistent earnings growth positioned it as an attractive secondary investment, contrasting sharply with Wilcox & Gibbs' lackluster performance and prolonged dividend drought. In summary, these comparisons underscore the complexities of market valuations, emphasizing the importance of discerning underlying performance amidst market fluctuations and speculative fervor. Chapter 18 offers a comprehensive analysis and comparison of various pairs of companies, employing the timeless wisdom of Benjamin Graham's value investing principles. Drawing upon historical examples and contemporary market conditions, the commentary underscores the enduring relevance of Graham's insights. The chapter commences with a quotation from Ecclesiastes, aptly illustrating the cyclical nature of markets and the perennial truth that there is no new thing under the sun. It then proceeds to update Graham's methodology of comparing companies, emphasizing the importance of evaluating stock prices relative to intrinsic value rather than succumbing to market hype or short-term trends. Each pair of companies examined in the chapter serves as a microcosm of the broader market dynamics and investor behavior. Through meticulous analysis, readers are guided to discern the distinction between stock price fluctuations and underlying business fundamentals. The narrative elucidates how seemingly exorbitant valuations can mask underlying risks, while undervalued stocks may harbor hidden potential. By juxtaposing companies such as Cisco and Cisco, Yahoo and Yum, Commerce One and Capital One, among others, the commentary elucidates the folly of market exuberance and the virtue of prudent investing. Notably, it highlights instances where investors fixated on growth prospects and market trends, disregarding fundamental metrics such as earnings, dividends, and balance sheet strength. Furthermore, the chapter underscores the role of market panics and sentiment shifts in creating opportunities for discerning investors. It advocates for a contrarian mindset, wherein market downturns can unveil undervalued gems amidst the turmoil, as exemplified by the cases of Ball and Stryker. Ultimately, the chapter reaffirms Graham's timeless principles, asserting that while market sentiment may fluctuate wildly in the short term, the long-term success of investors hinges upon adhering to fundamental analysis and rational decision-making. It concludes with a sobering reminder that speculative fervor inevitably yields to the gravity of intrinsic value, vindicating the prudence of value investing over the whims of market speculation. Chapter 19, Shareholders and Managements, Dividend Policy. Shareholders and Managements. Since 1934, we have consistently advocated for a more proactive and discerning attitude from shareholders towards their managements. We encourage shareholders to generously reward effective management and to seek clear explanations for subpar performance. If results are persistently unsatisfactory, poorer than peer companies, or lead to prolonged low market prices, shareholders are justified in questioning management competence and supporting efforts to replace unproductive leadership. Despite our long-standing advocacy, significant progress through shareholder activism has been minimal. A practical crusader might consider this lack of progress a sign to abandon the cause. However, the rise of takeovers has somewhat vindicated our efforts. Poor management often results in low market prices, attracting companies interested in diversification. These takeovers, through agreements with existing management or market share accumulation, typically offer prices reflecting the enterprise's value under competent management. Thus, Even passive shareholders have been rescued by these external actions. Poor managements are seldom changed by public shareholders, but rather by assertive individuals or groups. This trend has prompted boards of directors to be more vigilant in ensuring effective top management, leading to more frequent changes in company leadership. Not all underperforming companies benefit from such interventions, often experiencing prolonged poor results before external takeovers occur. Shareholders generally do not take initiative, and those who actively participate in annual meetings rarely need guidance on raising pertinent issues with management. However, shareholders should consider any proxy material advocating for management improvements with an open mind. Shareholders and dividend policy. Historically, dividend policy has been a contentious issue between minority shareholders who favored more liberal dividends and managements who preferred to retain earnings for business growth. In recent years, investor attitudes towards dividends have shifted. The argument for smaller dividends now centered on the potential for reinvested earnings to enhance shareholder value through profitable expansion. Previously, weak companies retained profits out of necessity, negatively impacting market prices. Today, strong, growing companies often retain earnings with investor and speculator approval under the premise of profitable reinvestment. This shift is exemplified by companies like Texas Instruments and Superior Oil, which experienced significant stock price increases despite paying little to no dividends during periods of high earnings growth. Investment sentiment on dividend policy remains divided. Some investors prioritize dividend income, especially from companies not focused on rapid growth, while growth companies are valued based on their expected future growth rather than current dividend payments. We advocate for a balanced approach where managements either maintain a normal payout ratio or clearly demonstrate that retained earnings are effectively increasing per-share earnings. Shareholders have the right to question low payout policies, especially when they contribute to undervalued market prices. Stock dividends and stock splits. Investors should understand the difference between stock dividends and stock splits. Stock splits reconfigure the common stock structure, typically to lower the market price per share. Proper stock dividends, on the other hand, represent reinvested earnings over a recent period and are reflected by transferring amounts from earned surplus to capital accounts. Stock dividends provide tangible evidence of reinvested earnings and offer tax advantages over equivalent cash dividends combined with stock subscription rights. However, many academic writers criticize stock dividends as mere paper exercises. We disagree, emphasizing the practical and psychological benefits for shareholders, such as the ability to cash in reinvested profits without disrupting their original investment. Public utility companies often combine liberal cash dividends with stock subscriptions, a practice that could be more efficiently replaced by stock dividends to save substantial income taxes for shareholders. We urge a modernization of dividend policies, particularly for public utilities, to better align financial practices with shareholder interests and contemporary investment realities. Commentary on Chapter 19, The Intelligent Investor. The Most Dangerous Untruths. G.C. Lichtenberg's assertion that the most dangerous untruths are truths slightly distorted aptly sets the stage for a discussion on Chapter 19 of The Intelligent Investor. This chapter addresses significant transformations in Benjamin Graham's approach and the ongoing relevance of his insights in today's financial landscape, particularly concerning corporate governance and shareholder rights. Evolution of Chapter 19. In the first edition of The Intelligent Investor, Chapter 19 spanned nearly 34 pages, exploring shareholders' voting rights, assessing corporate management quality, and identifying conflicts of interest between insiders and outside investors. However, by the final edition, Graham had condensed this extensive discussion into a brief 8 pages, focused primarily on dividends. The drastic reduction reflects Graham's apparent disillusionment with investors' apathy towards actively monitoring corporate management. Despite this, recent corporate scandals highlight the enduring importance of Graham's initial warnings and the necessity for vigilant investor oversight. Theory versus practice. Graham's original 1949 discussion emphasized that shareholders theoretically wield significant power, capable of hiring and firing management and influencing company direction. In practice, however, shareholders often exhibit passivity, voting in alignment with management recommendations regardless of performance. Graham's critique underscores the paradox that while shareholders possess the power to effect change, they rarely exercise it effectively. The intelligent owner Graham insists that owning a stock confers ownership of the company, making its managers accountable to shareholders. He encourages investors to be proactive owners, scrutinizing management efficiency and ensuring their interests are adequately represented. To evaluate management, shareholders should compare profitability, size, and competitiveness against industry peers. If management is found lacking, shareholders should advocate for changes, engage in proxy material, and consider external audits of management performance. The Enron case study. The Enron scandal exemplifies the consequences of neglecting Graham's advice. Enron's 1999 proxy statement revealed conflicts of interest involving CFO Andrew Fastow, which should have raised red flags for diligent investors. The case demonstrates the critical need for investors to scrutinize proxy materials, use common sense, and act upon troubling findings. Dividends and management interests. Graham also critiques the managerial preference for hoarding capital rather than distributing it as dividends. He argues that efficient finance necessitates optimal use of shareholder capital, which managers often misallocate. Historical trends reveal that companies with higher dividends tend to experience superior earnings growth, challenging the notion that management can invariably reinvest profits more effectively than distributing them to shareholders. Stock buybacks and executive compensation. Stock buybacks, theoretically beneficial, often serve to counteract the dilution caused by executive stock options. Graham criticizes this practice, noting that companies frequently buy back shares at inflated prices, effectively transferring wealth from shareholders to executives. This misalignment of interests calls for shareholders to closely monitor executive compensation and stock repurchase strategies. Keeping their options open. Excessive executive compensation through stock options further exacerbates the disconnect between management and shareholder interests. Graham advocates for stringent controls on option grants and emphasizes that executive rewards should be contingent on long-term superior performance, aligning with shareholder value. A final thought. Graham proposes that independent directors should provide detailed reports to shareholders on company management, dividend policies, and executive compensation. Such transparency and accountability could empower shareholders to become intelligent owners, ensuring that their interests are prioritized and protected. Overall, Chapter 19 serves as a powerful reminder of the responsibilities and rights of shareholders. Graham's insights remain pertinent, advocating for active engagement and vigilant oversight to safeguard and enhance shareholder value. Chapter 20, Margin of Safety as the central concept of investment. The central concept of investment, as discussed in Chapter 20, is encapsulated in the phrase margin of safety. This principle, distilled into 3 words, is essential for sound investment strategy and serves as a guiding thread throughout the book. The importance of margin of safety. Experienced investors recognize the margin of safety as crucial in selecting sound bonds and preferred stocks. For instance, an investment-grade bond of a railroad company should have earnings that cover its fixed charges at least 5 times over, providing a buffer against future declines in income. This margin protects the investor by ensuring that even if earnings decrease, they will still suffice to cover the interest obligations. Application to bonds and preferred stocks. For bonds, the margin of safety can also be determined by comparing the enterprise's total value to its debt. If a company worth $30 million owes $10 million, a 2/3 reduction in value would still safeguard the bondholders. This cushion above the debt is often assessed using the average market price of the company's junior stock issues, which typically correlate with average earning power. Transition to common stocks. The margin of safety concept extends to common stocks, but requires modifications. A common stock may be considered sound if it offers a safety margin similar to a good bond. For example, During the low price levels of 1932 to 33, many industrial companies' stocks were valued less than the bonds they could support, offering both safety and profit potential. Expected earning power and market rates. In normal conditions, the margin of safety for common stocks is tied to expected earning power, which should be significantly above bond rates. For example, if the earning power is 9% and the bond rate is 4%, the stock investor gains a 5% margin annually. This excess, combined with reinvested earnings, contributes to the stock's overall value growth, providing a buffer against loss. Diversification and margin of safety. The principle of diversification is closely linked to the margin of safety. While a single investment might fail, a diversified portfolio increases the likelihood that overall profits will outweigh losses. This concept is fundamental to conservative investment strategies, ensuring a balanced approach to risk and return. Investment versus speculation. The margin of safety serves as a criterion to distinguish investment from speculation. Investment decisions should be based on solid arithmetic reasoning and statistical data, rather than subjective judgments. True investments are characterized by a demonstrable margin of safety, providing a quantitative basis for confidence in future returns. Conventional and unconventional investments. Conventional investments suitable for typical portfolios include government securities, high-grade stocks, and tax-exempt bonds. Unconventional investments, appropriate for enterprising investors, might involve undervalued stocks or medium-grade bonds purchased at significant discounts. Despite their lower quality ratings, these can be sound investments if bought at sufficiently low prices, creating a substantial margin of safety. Business principles applied to investment. Investing wisely parallels running a successful business. Investors should: 1. Know your business. Understand the securities and their values deeply. 2. Supervise diligently. Ensure any delegated decisions are under trustworthy management. 3. Base operations on reliable calculations. Avoid ventures with high risk and low potential gains. 4. Act with courage and conviction. Trust in sound judgment and factual data. Summary. Achieving satisfactory investment results is more straightforward than often perceived, provided investors adhere to the principles of margin of safety, thorough knowledge, careful supervision, prudent calculations, and courageous actions. These principles collectively ensure a disciplined, business-like approach to investment. Chapter 20 delves into the multifaceted nature of risk within investment, drawing parallels with existential uncertainties. It commences with a poignant quote from Agent Fox Mulder of The X-Files, setting the stage for a discourse on navigating the capricious world of finance. The chapter posits risk as an ever-evolving concept, morphing with market dynamics and investor sentiment. It chronicles the shift from the late 1990s euphoria, where risk was construed as lagging behind in wealth accumulation, to the sobering realities of the early 2000s, where risk materialized as the potential obliteration of financial portfolios amidst market downturns. Central to the narrative is the axiom espoused by J.K. Klingenstein: don't lose. This mantra encapsulates the essence of prudent investing, emphasizing the paramount importance of preserving capital. Through compelling anecdotes, such as the meteoric rise and precipitous fall of JDS Uniphase Corp., the chapter elucidates the perils of overvaluation and underscores the significance of Graham's margin of safety. Furthermore, the discourse transcends external market forces to probe into the internal landscape of investors. It delineates how risk is not merely extrinsic, but intrinsically intertwined with individual temperament and decision-making prowess. Drawing on insights from Nobel laureate Daniel Kahneman, the chapter underscores the significance of well-calibrated confidence and correctly anticipated regret in making informed investment decisions. The analogy to Pascal's wager serves as a philosophical underpinning, illustrating the dichotomy between probabilities and consequences in decision-making under uncertainty. Peter Bernstein's adaptation accentuates the imperative of prioritizing consequences over probabilities, resonating with Graham's advocacy for safeguarding against potential pitfalls. Ultimately, the chapter advocates for a holistic approach to risk management, advocating for prudent diversification and temperance in succumbing to market fads. It instills a sense of resilience and equanimity in investors, affirming that, irrespective of market vicissitudes, steadfast adherence to sound investment principles will weather the tempests of financial uncertainty. Postscript. In this insightful narrative, we encounter the trajectory of two seasoned investors who approach the dynamic realm of Wall Street with a blend of caution, astuteness, and a unique investment philosophy. Their journey underscores the efficacy of a conservative yet diversified strategy, one that prioritizes sound valuation metrics over speculative fervor. Through meticulous selection and timely disposition of assets, they cultivated a portfolio that weathered market vicissitudes while delivering commendable returns, averaging approximately 20% annually. The pivotal moment arrives when they eschew conventional wisdom and invest a significant portion of their fund in a burgeoning enterprise, despite its lack of favor among mainstream investors. Their decision, anchored in a discerning assessment of the company's intrinsic worth relative to its market valuation, proves prescient as the enterprise flourishes, generating extraordinary returns. Despite reservations about the exorbitant valuation, their steadfast commitment to their investment, viewing it as akin to a family business, reaps substantial rewards, elevating them to millionaire status. This anecdote serves as a compelling testament to the multifaceted nature of success in Wall Street. It underscores the significance of disciplined preparation, discerning judgment, and the courage to seize opportune moments. While luck and a singularly shrewd decision undoubtedly play a role, they are invariably underpinned by a foundation of expertise and readiness to capitalize on emerging prospects. The narrative resonates with the notion, while not all investors may replicate such meteoric gains, the financial landscape teems with opportunities for those who remain vigilant and enterprising. Ultimately, it celebrates the thrill and potential rewards inherent in navigating the intricate tapestry of financial markets, offering a compelling invitation for intelligent investors to engage in this exhilarating pursuit. The commentary on Postscript offers a thoughtful reflection on investment philosophy, drawing parallels between the principles of investing and the adventurous spirit embodied in literary works such as Homer's Odyssey and Dante's Inferno. It begins by emphasizing the distinction between managing risk and avoiding it, highlighting the example of Benjamin Graham's bold but calculated investment in Geico, which, despite its apparent concentration, was underpinned by meticulous analysis and an understanding of potential downside protection. The commentary then shifts to the contemporary investment landscape, characterized by uncertainty and apprehension fueled by economic concerns, market volatility, and geopolitical risks. It underscores the perennial nature of uncertainty in investing, emphasizing that embracing uncertainty is intrinsic to the endeavor. The narrative underscores the importance of optimism and faith in the future as essential attributes for investors, echoing Graham's belief in a better tomorrow. Drawing on literary allusions, particularly the excerpt from Dante's Inferno, featuring Ulysses' impassioned call to his crew to venture into the unknown, the commentary likens investing to an adventurous voyage into uncharted waters. This analogy reinforces the idea that investing entails both risk and opportunity, requiring courage and conviction to navigate through uncertainty towards the promise of growth and prosperity. In conclusion, the commentary suggests that with Benjamin Graham's insights as a guide, investors can embark on their investment journey with confidence, recognizing that while the financial future is unpredictable, it is also ripe with potential for those who approach it with prudence, courage, and a thirst for knowledge.